need the Fed to start cutting. We think that starts in June.
I thought we'd have 3 cuts this year. I'm probably going to dial back on that.
I think that they are sticking to their slower to lower interest rate mantra.
They've pretty clearly told us that they're not going to pull the trigger in March. So by the time May, June rolls around, we'll have a lot more data on everything.
The reality of the situation is they just continue to do nothing and promise they're going to cut rates.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 pulling back just a touch. Nvidia, it makes up about 4% of the S&P, about 5% of the Nasdaq 100, and around about 99% of the enthusiasm to buy equities. Bramo, they report after the close.
So let's talk about some statistics. Yesterday, people getting concerned that maybe there's too much optimism baked into shares that have skyrocketed over the past couple of years. It dropped 4.4%. Sounds not that significant. The worst drop since October. In market cap terms, that's $79 billion. That's insane, just to give you a sense of how big this company is.
We'll talk about some of the upgrades from UBS and Goldman Sachs on the broader equity market. Let's talk about the upgrades on a single name. Annmarie, UBS, Mizuho, Morgan Stanley, Bank of America, Goldman, all boosting their price targets on this name over the last month, going into this report later on today.
It's unbelievable, and I'm just waiting to hear about what the company has to say regarding China. We know that this is a big part of their market space, but given the latest export controls that came out of the U.S. administration in the fall, they're having to downgrade some of their technology in order to sell some chips in China. And for them, it's how do they maintain that market share? Because at some point, there's going to be Chinese competitors who say we can actually get better technology by doing it ourselves, because we cannot rely on the United States.
It's such a good point. There's another dimension of the policy story down in Washington I want to discuss as well. The senator from Massachusetts has something to say on Capital One and Discover. Guess what it is? You'll never guess. Pull up the quote if you can. Regulators must block it immediately, Bramo. They must block it immediately.
Okay, who is surprised that Senator Warren came out about Capital One and Discover having an issue?
Right on time.
I mean, really, it was pretty much on cue. But here's the question. What will they let to get through? Right? What's an acceptable deal to actually get done? And how does this really transpire in a world where bigger is better when it comes to economies of scale and just general economics?
Well, this is a good question this morning, because after she tweeted about Capital One Discover, Senator Warren also tweeted about Kroger. And the quote was, this merger should be stopped. And Bloomberg is reporting that the FTC and a group of states are poised to sue as soon as next week to block that merger. So if you're Capital One and Discover and you're looking at what the FTC is doing right now with Kroger, do you think you have a chance to get this deal through in 2024?
The Democrat from Massachusetts loves to kick capitalism in the teeth and has done over much of the last decade. Speaking of kicking capitalism in the teeth, can we turn to China? The latest news out of China, our reporting right here. China has banned major institutional investors from selling more shares than they buy during the first 30 minutes of trading and the last 30 minutes of trading. And Lisa, they've also created a task force, according to our reporting, with the nation's stock exchanges to monitor short selling and issue warnings to firms that profit from those wagers.
Well, okay, and this comes after one of their biggest quant funds was banned for trading for 3 days after dumping a whole host of shares within minutes yesterday or a couple days ago. To me, this sort of raises this question, what's their goal? I mean, is this going to be opening up their market to new people? Is this basically the way that they're going to manage the underperformance of their stock market?
We started yesterday by talking about addressing the causes of the weakness. We talked about interest rate cuts, probably not going to work. Are they going to do something on the fiscal side of things? They're going to ban selling again. They're going to ban selling. That's the approach.
It feels like putting a Band-Aid over an amputation, which is part of the problem.
Yeah, I think that's a great one.
And I think right now it really raises this question of how much does it give people confidence to go back into a market that is heavily manipulated and heavily controlled? It creates a real problem.
Or maybe if you can't sell it, will create a lot of confidence, because there is only one way this can go, Bramo, and that's higher.
Okay, it's theoretically, yes. On the other hand, if you don't get that enthusiasm, who's going to be pouring money in if at any given time you're basically going to be hooked off the stage and being told, forget it, you're not good enough?
I'm not sure how many international investors want to dabble in what's going on over there. currently. Let's turn to the broader market. Equity futures on the S&P 500 negative by 0.2%. In the bond market, yields coming in a couple of basis points, 425.77. The euro not doing much, still in and around 108 on that currency pair. Coming up on this programme, John Stolfus of Oppenheimer Asset Management ahead of Nvidia earnings. Greg Valliere of AGF Investments as Nikki Haley vows to stay in the race regardless of South Carolina's results this weekend. And Claudia Sahm a little bit later this hour, the former Fed economist, on why she thinks the Fed should already be cutting interest rates. We begin with our top story. Nvidia set to report after the closing bell. Today's earnings and forecast looking to justify a market cap running beyond $1.7 trillion. John Stolfus of Oppenheimer expecting the market rally to continue to expand beyond the Magnificent Seven, writing this. In the S&P 500, 8 sectors are posting positive returns. In our view, this shows a continuation of a broadening in the rally that began at the end of October last year. Established tech companies are likely to prove to be key holdings. John, I'm pleased to say, joins us right now. John, let's get into that broadening out. What is it that you see that's driven some of that you think will prove to be durable through the year ahead?
Well, John, great to be on the show. Thanks for having me. I would have to say, one thing is I think investors are getting the idea that there's other values within the market other than technology. And a lot of it has to do with sectors that can be served by technology to become more efficient. In addition to that, as we've mentioned before in our conversations, we do believe that a lot of people are getting the idea that indeed Social Security becomes less of something to rely on as a core in one's retirement, and the need for investments that point to equities in terms of retirement portfolios. So we think the market has good support here. We think the Federal Reserve is doing a good job, and the lumpiness in inflation is just part and parcel of going through what we're going through, a normalization of interest rates.
John, you pointed to a structural reason to buy equities. Can we talk about some of the cyclical issues in front of us at the moment? You like cyclicals over defense. You seem to like energy. John, what's behind that?
Well, with the reason why we like energy is the bridge between a point where the scale in the infrastructure for alternative energy will be achieved for it to become the major part of energy is years and years away, and the bridge that needs to take us there is traditional fossil fuel energy. And I think I'm certainly not one of the few people to think that. It's a general thought is that before we go all green, there's definitely a mix between black gold and greening that needs to be to get us there.
Is the broadening?
So we'd also say, by the way, oil companies have been known to distribute energy successfully for the last 130 some years. They should probably be given an opportunity to be at the core of the new energy program.
John, is the optimism about some sort of broadening out at the expense of the leaders so far, namely big tech?
I don't think so. I just think what it is, it's not that I don't think technology remains part of the leadership. Just the size of the sector would tell us that, it's important that it keeps running. But it just happens to be, we thought for quite a while now that technology today, very different from where it was during the tech bubble, really reflects the fact that technology is likely, when we look back at it from a historical perspective, likely in a position parallel to where the automobile was in the early 20th century, after Henry Ford had mechanized the assembly plant, brought up the quality and reduced the cost. The accessibility to the automobile, and it goes similar with technology for both all sizes of business and the consumers. This makes for a much more efficient society, and we're all on the upgrade cycle, whether we admit it or not.
John, I have to say, you used to be the biggest bull on the street. You're not anymore. You're not even close. There are people who are absolutely outpacing you, including Jonathan Golub and Patrick Palfrey at UBS yesterday, who now are talking 5,400. Based on your optimism, the fact that there's almost no gains on the S&P to get to your price target by the end of the year, does that give you pause?
It most certainly, when I see a lot of, and I'm not saying that the last few names, I don't recall exactly where they were, but there's been a bear capitulation last year and this year at an extraordinary rate. It always concerns us when everybody comes to our side of the boat. The only thing is that it does look from a perspective of fundamentals. If you just look at the earnings, Q4 earnings, and you look back at Q3 earnings, it just shows that earnings are rising, more earnings are rising. You have double-digit earnings growth in cyclical and technology sectors. I think this particular earnings season, utilities joined cyclicals and technology for double-digit earnings growth. That's curious thus far, based on what I'm seeing on my Bloomberg EA page. But we just have to say, Fed's doing the job. The consumer is remaining resilient. Jobs postings resilience, and corporate earnings showing resilience. We're not looking for robust here. And that tells us that maybe this positive attitude that we're beginning to see among the sea of strategists that exist might not be a bad call, though we will keep the party hats in the box for now. We're not going to be dancing and celebrating.
John,
it's early in the year.
Just to be clear, does that mean that you are going to upgrade, or that you're basically happy where you are with respect to the forecast?
At least our discipline is that we will not change our target until our target is exceeded or our target becomes impractical in terms of where the market would have to go to attain it. So we're waiting for the market to take us to a close over 5,200, at 5,200 or over, and then we'll address it.
John, you talk about, instead of deglobalization, it's reglobalization. It makes me feel like when the U.S. administration talks about the fact that they're, not bifurcating with China, or, they're just trying to find other ways to shore up the supply chain. But when you want a reglobalization trade, what are you looking at?
Reglobalization really just means a diversification away from one country centric global supply chain. And I think that began probably about 2016, slowed some when China basically just ate the tariffs, I think. And then later on in the process of coming out of the pandemic, it became pretty obvious that one country-centric supply chain wasn't working very well. And companies now are diversifying their sources on a global basis. And we think that's good for Latin America. If we can get peace in Eastern Europe, it'll be good, and both. It should be good for both and emerging markets in Asia that are friendly to the U.S. We can't help but think that it benefits emerging markets, India included, and Mexico, Brazil, just for a few. This is a reglobalization for the simple reason. If you look at our trade deficit has just stays pretty bad. Since 1992, it's deteriorated. It just shows that both U.S. businesses and the consumer like to buy foreign goods because it's the competitively priced play. People like a good deal.
Hey, John, it's great to hear from you. Lisa says, come back when you've upgraded stocks. John, Thank you. John Stolfus of Oppenheimer Asset Management on the latest. No longer the big bull on the street. That's Jonathan Golub and Patrick Palfrey over at UBS. Here's the quote from them. Lisa, I think this is really interesting. While the market sold off on more robust CPI and PPI reports last week, our work indicates these demand-driven readings are constructive for future returns. So pushing out rate cut calls and the reasons for that. We were talking about it. Is it good or is it bad? We would argue it was bad if it's about hotter inflation reads. Jonathan Golub saying it's good for stocks.
Basically saying that it's the demand side of the story and the fact that people are going to keep on buying, which really plays to what Goldman Sachs was saying as well. Basically, this is going to be an earnings-driven rally that is going to be on the heels of strength that allows the Fed to keep rates where they are. I will just say, it's notable that Golub and Palfrey lifted their forecast on January 16th to 51.50. The original call of 48.50 was on December 11th. This is moving so quickly. It really is sort of surprising.
They've done it twice, a couple of days after Goldman also have done it twice. I think they started in October, November time as well.
Exactly. So
just ridiculous.
Yeah, moving faster than people can really
chasing this rally, I think it's fair to say that's what this is. Equity futures on the S&P 500 right now, negative by about 0.25%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. plans to unveil sanctions against Russia on Friday following the death of opposition leader Alexei Navalny. President Biden blames Putin for the death of Navalny, who had been imprisoned in the Arctic. The White House says the sanctions include a substantial package of financial penalties that target Russia's defense and revenue sources. HSBC shares are falling. Fourth quarter profit plunged 80%. The bank also took a $3 billion impairment on its holding of China's Bank of Communications. CEO Noel Quinn also announced a $2 billion share buyback. HSBC, while it was supported by higher global rates, it is still facing headwinds from one of its key markets, and that's China. A tie-up between two supermarket giants could be in trouble. Sources tell Bloomberg that the FTC and a group of states will sue to block the combination of Kroger and Albertson. The suit is expected before Feb 28th, and that's when an agreement not to close the deal expires between the FTC and the companies. Both Kroger and Albertson are prepping to meet with the FTC chair Lina Khan to persuade the agency not to sue. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this programme, Nikki Haley vowing to stick around and stay in the race.
I refuse to quit. South Carolina will vote on Saturday. But on Sunday, I'll still be running for president. I'm not going anywhere.
She's not going anywhere. That conversation is coming up next, live from New York City this morning. Good morning. Equity futures on the S&P 500 negative here by around about 0.2%. Yields coming down about a basis point. The 10-year 426.16. Under surveillance this morning, Nikki Haley vowing to stick around and stay in the race.
Many of the same politicians who now publicly embrace Trump privately dread him. They know what a disaster he's been and will continue to be for our party. They're just too afraid to say it out loud. That's why I refuse to quit. South Carolina will vote on Saturday. But on Sunday, I'll still be running for president. I'm not going anywhere.
Here's the latest this morning. Nikki Haley trailing the former president by an average of around 30 points, according to the latest polls. Haley struggling to get a boost from voters in her home state of South Carolina ahead of the primary this weekend. Greg Valliere of AGF Investments writing that despite Trump's dominance in the primaries, he does face challenges going into the general, writing this. His comments on NATO and his refusal to support Ukraine and Russian dissidents have concerned moderates, who were the key to his re-election prospects. Greg Valliere, I'm pleased to say, joins us now. Greg, before we get to Trump, let's talk about Nikki Haley. What is the strategy for her now?
Well, I guess she will stay in, John. I think it's not going to go very far. She, I think, will maybe stay in until Memorial Day, but I can't see a scenario where she can win the nomination. The intriguing thing is this group called No Labels, which would love her. They lost their two leading candidates, Larry Hogan and Joe Manchin, so they would love to have her on the ticket. I'm not sure she would want to do it, but if she says she's not going anywhere, that's the only place I could see her going.
Greg, Lisa asked that question, and she certainly didn't want to talk about it when we spoke to her in the last week or so. Greg, talk to me about financing. Does she have the funds to stay in this race for as long as she possibly can?
She has money. She's a great debater, one of the best debaters in all of politics. And she's fairly moderate, although she's changed her tune. 4 or 5 months ago, she was not this moderate. But she does have attributes, including money.
When it comes to money, what does it look like for the Trump camp? Because he's using a lot of these campaign donations to pay his legal fees, and it looks like he's facing a huge crunch on the cash front come this summer. Does the RNC step in and start helping him on his legal fees, or are they going to focus on campaign finance?
Well, since the RNC will be basically a wholly owned subsidiary of Donald Trump, I'm sure he can get some money from them. I think the big story on money is Joe Biden. He's out in California today raising more. He's raised a ton of money. That's not going to be a problem for him.
Does that shock you, given the fact that the whispers in the Democratic Party is that they don't think he should be the candidate?
But I do think, though, they believe he will not drop out and he will run. And if he is going to run, he needs a lot of money, and he's getting it by the bushelful.
Can we want to ask you also about what's going on in terms of mega mergers and how Capitol Hill is going to respond? We know Senator Warren has come out and said the Capital One Discover deal should not go through. We know the FTC, according to our reporting, is prepared to block the Kroger deal. How do you see the mood music coming out of Washington in terms of deals going through this year before the election?
It's clearly become negative. I think if these mergers are approved, it's going to take a long time. I'm not sure they can get done in time for the November election.
Is this one of the biggest places where there actually is daylight between who may be president? In other words, the policy is dramatically different if Biden is in the White House versus Trump.
Oh, yeah, there are big differences. That's one. I think another one is Jerome Powell. I think Trump would try to dismiss him within days of his inauguration. So there are a lot of big differences. One of the most intriguing ones is defense. We're going to see in Biden someone who would spend more on defense than a Republican, Donald Trump.
I'm struck by just this question of going back to Nikki Haley and why she's staying in. When you're talking about Donald Trump, there's sort of a full circle here. Is there a feeling that one or both of these candidates are going to drop out, with Trump being forced to with some of the legal pressures, and she's staying in long enough to pick up where he leaves off?
I think you've hit on it. Her strategy is clearly to see if Trump stumbles. If he gets convicted in a trial, if he makes more gaffes like he did about NATO, that's why I think she's staying in. She's staying in hoping he trips up, and he might.
Greg, do you really think that a future Trump administration may cut defense spending?
Well, the word cut, let's say that it would level off. I think defense spending increases would clearly slow down. The Republican Party, as you know, has become more isolationist, and I think that means the glory days, the fat days for the defense industry are over for now.
Greg, how popular is that stance in this country at the moment?
Well, I think it is popular in much of the country. You see in the Midwest, for example, or among young Republicans, they're isolationists. They don't want to support Ukraine. They don't want to spend a lot of money on defense. Although I think the mood on Ukraine has changed significantly in the last 48 hours. I think Ukraine will get something.
I've got to say, Greg, I was struck by J.D. Vance's editorial in the Financial Times, a notably European-leaning publication, where he basically said the United States has provided a blanket of security to Europe for too long. He talked about how essentially the U.S. funding of their own defense that supports other nations is basically a tax on the U.S. that benefits the rest of the world. Do you expect this to be a popular stance going forward, understanding that J.D. Vance is maybe more on the fringes than, say, a Mitch McConnell? Is this becoming mainstream?
Yeah, and you have a divided party. It's Vance and many other young Republicans who just don't want to do what Mitch McConnell has wanted to do on defense. So that's a big shift. I do think that Mitch McConnell and Joe Biden will get something.
Greg Valliere. Greg, we've got to leave it there. Greg, it's good to hear from you, as always. Greg Valliere there of AGF Investments. You're all familiar with the meme, aren't you? The meme that has the Navy destroyers, the aircraft carriers in the picture, and then the text says something like, "You're about to find out why Americans don't have healthcare." That's real. We've been talking about this for a long time. For the people outside of America that love to criticize how poor the infrastructure is, the lack of socialized healthcare, the Europeans that can sit on those towers, those ivory towers, and look down their nose about what happens in the United States on those issues. I think the J.D. Vance point in the Financial Times is a pretty important piece, very easy to dismiss, but when you really think about the bigger issues at play here, for a long time, the Europeans have been able to get away without spending much on defence. And watching bill after bill, monster bills, go through Congress, spending huge sums of money on American defence, which the American taxpayer, to some extent, big deficit, get it, to some extent, has to finance. That's an issue, and it's an issue they're taking on.
This line from him: as the American defense budget nears $1 trillion per year, we ought to view the money Europe isn't spending on defense for what it really is, an implied tax on the American people to allow for the security of Europe. That said, is this the appropriate time to be hammering on this point when Ukraine is on the brink of potentially suffering for some pretty massive losses? It's sort of a question of what do you do with that argument, given the fact that a lot of Europeans are waking up to this and are actually acknowledging it and saying they need to invest as well.
Also, Pew recently came out with some new research, and a majority of Americans think that it is important for the U.S. to continue to support Ukraine. So to Greg's point, at some point, I do think Senator McConnell and Biden will get it done, but is it the last package Ukraine will see?
That's the big debate right now. Coming up on this programme, up next, the best performing stock on the S&P 500, reporting earnings after the close. Live from New York City following a couple of days of losses. Equities down again by 0.25% on the S&P 500, down on the Nasdaq by 0.5%. Today is not about the Fed speak, the Fed minutes, the economic data this week. It's none of that. It's all about the earnings from one stock, Nvidia, after the close. If you switch at the board in the bond market, 2-year, 10-year, 30-year, looking a little something like this, down a basis point, 426.35 on a 2-year, down 2 basis points to 459.34. Those Fed minutes, Lisa, we can talk about them for a heartbeat, a couple of seconds if you want. I want to understand just how together this committee actually is, given the struggles that Chairman Powell appeared to have in the news conference, reflecting some kind of consensus on the committee.
Do they offer more guidance on what kind of thresholds have to be met for them to cut rates? And is that maybe where some of the disagreements are in play? Because we didn't really get a lot of color on that. A lot of people, note after note, in very elegant way, one way after another, said that nothing's going to happen. These are going to be really boring minutes. And basically people are saying, this is sort of on the back foot right now with respect to all the Fed speak and with respect to the Fed minutes.
I think you've got to think about what's changed in between the meeting and these minutes as well. Hot payrolls report, hotter than expected CPI, hotter than expected PPI. The ISMs we've seen have been pretty decent as well.
Yeah, although some people are saying this might even open the door to another rate hike. And there have been a number of people...
You say some. I mean, are we just talking about one man?
We're talking about someone whose name rhymes with Wary Wummers. But I'm curious about whether we go forward with this sense of people trying to push back on that idea. Ian Lingen basically saying we're wary of the conversations about putting another rate hike on the table this far into the cycle. Other people basically being a little bit more aggressive. That's sort of where the nature of the conversation is.
It's a nice conversation point for now. It's a good way of getting yourself in stories and making headlines, I guess. Let's turn to foreign exchange. The euro looks like this. I mean, that can change. I'm not saying it's not going to change. I'm just saying for now it doesn't make a ton of sense.
Try to get to stories.
The euro, 107.98. We're negative here by 0.1%. David Folkers-Lando, Deutsche Bank, had this to say. Could we have the Fed battling with sticky inflation this year, just as Europe and China are seeking to combat more disinflationary forces? That would have currency implications, and our FX strategists remain bullish on the dollar versus the euro. That would make an interesting year.
Especially because that's kind of what's playing out. I mean, on one hand, you are seeing stickier inflation in Europe and elsewhere because of some of the same dynamics post-pandemic. But if that shifts, what does that do to the U.S. that has been an echelon of isolationism, regardless of who's in the White House, with respect to the U.S. consumer?
The euro, 107.97, that currency pair negative by 0.1%. Under surveillance this morning, our top stories, chip maker and AI giant Nvidia reporting fourth quarter results after the closing bout today. Investors will decide whether the company's earnings and forecasts justify a gain of 40% year to date and a market cap to rival Amazon. Options are pricing in a swing of nearly $200 billion, which is a few percentage points for Nvidia. In value, pending today's results a little bit later. Just the numbers, Lisa, they're astronomical. And every single time we set the bar higher for them, they've beaten by double digits. They've raised again. And I think expectations today, what is truly a beat for Nvidia? Is it a double-digit beat and a raise?
That's the reason why I think we saw a little bit of softness yesterday, the sense that maybe the bar is so high and we don't even know how high it is that it can't be good. And there's this expectation that usually the stock swings by 10% in one direction or another, usually up, after its earnings. So if you're trying to get ahead of that, you basically reduce your position and try to take some chips off the table or whatever cliche you want to use. But this is, to me... Yeah, okay, thanks. That's great.
It's good, it worked. It was a nice pun.
Thanks, I appreciate it.
Enjoyed that.
Thank you. Okay,
stock is down by 1.76% in the pre-market. Mandeep Singh, Bloomberg Intelligence, who'll join us on that name with more puns in just a moment. I want to turn to this story just quickly. President Joe Biden is set to unveil major sanctions against Russia after the death of opposition leader Alexei Navalny. The White House is not releasing any more details until Friday, but in commodities, aluminium and nickel surged on the news. Traders have been on the lookout for new curbs on Russian metals after they escaped earlier sanctions. Saturday, of course, will mark 2 years since Russia's invasion of Ukraine. Largely spared, Anne-Marie. You wonder if they're going to be this Friday.
Well, the UK hinted towards this in December when they were barring individuals from trading some of these commodities. And they said, we will look for international partners to take a coordinated action. So this is something that's still left on the table. But you have to think, is this administration going to go so far that the repercussions are going to hit their own economies? Because what we've seen when it comes to oil and gas, which is how Putin continues to keep his economy functioning, how he continues to fund this war, is that they're willing to let them trade it with a caveat of a price cap.
In other words, it hasn't worked. right? I mean, essentially, pretty much everyone has said that the sanctions have not worked. It has not discouraged Russia. It has not reduced the amount of money that they've really brought in that materially. So this raises a question. Is this basically a messaging effort to basically say we're taking a hard line and then to basically come out and signal we're going to do something harsh on Friday? Does that basically raise the bar that they're going to have to disappoint?
In 2021, when Biden sat down in Geneva with Putin, he was asked specifically, what will the consequences be? Will there be consequences if Navalny was to show up dead? And he said, yes, they'd be, quote, devastating. But the table and the tools left in the toolbox, there's not a ton, given the fact that they used a lot of this when Putin invaded Ukraine.
We'll find out how devastating those sanctions might be this Friday. 2024 is shaping up to be the year of the regulator. Fubo TV is suing ESPN, Warner and Fox Sports over a deal to launch a joint sports streaming service. Fubo argues the new plan would not allow the company to carry a small bundle of sports-focused channels. The TV giants are expected to launch a brand new platform this fall, raising attention from sports leagues and regulators alike. Fubo is a 9-year-old streaming service with 1.5 million subscribers in North America. Shares have fallen since that joint venture was announced in the last couple of weeks. Lisa, unsurprising, I think we're going to see a lot more of this on a lot more fronts.
So $79.99 is the price per month for Fubo, right? This is expensive, especially considering that the price point for the other streaming network is $50. And they're saying they're going to be denied rights to stream some of these sports channels because they're going to want to, some of these streaming sites are going to want to push their traffic to their new site. I mean, I kind of feel bad for them, but I also kind of feel like are consumers really benefiting here?
Exactly. Are you making the argument this is better for the consumer regardless of what Fubo thinks?
Kind of.
Yeah.
I mean, sorry.
Aren't the leagues going to have something to say about all of this as well?
I mean, I assume so, but maybe the leverage has shifted a little bit more to some of these major networks. I don't know, but from a consumer standpoint, $80 a month, $50 a month, I mean, yeah.
This is much cheaper, the JV, and also the idea that you can get a lot more, it sounds like. But John, to your point, will the leagues have something to say about it? The NFL found out when they were all huddled in Las Vegas for the Super Bowl that Disney, Warner, and Fox were even thinking of doing this.
They say this joint venture will not offer joint bids on sports TV rights. Let's just see how the next round of sports TV rights actually goes and how competitive these institutions still are with each other. I wonder. They're not going to say it's the motive. I'm not here to suggest it was. I just want to understand what the consequences will be in the years to come.
Basically, why else would they do this if they weren't going to be able to have
we asked the question
of scale? We did, and they gave an answer, and you seem like you're buying it.
Absolutely. I always buy everything I'm told by CEOs and institutions, aren't you?
100%.
Every single time.
All the time.
Turning back to NVIDIA. The company's earnings due out after about likely the most watched report of the quarter. Mandeep Singh, Senior Technology Analyst for Bloomberg Intelligence, joins us now for more. Mandeep, the stock is down by about 1.2%, 1.7%, 1.8% this morning. It's had a massive run-up again year to date of about 40%. We've been trimming those gains over the last few days. And Mandeep, as Lisa pointed out, maybe some nervousness around this name now because we keep raising the bar and they keep beating by double digits and then raising again. Mandeep, what is a beat for NVIDIA today? Because a beat for NVIDIA is very different to a beat for everybody else.
Yeah, look, I think we've gone from skepticism around what's the kind of the revenue run rate and margins, how long can they hold that, to really nothing could go wrong for NVIDIA, even though there are a lot of issues, you know, when it comes to the China exposure and hyperscalers developing their own chips. And anytime you see headlines like NVIDIA surpassing Alphabet or Amazon in market cap, you have to ask yourself, you know, what is the fundamental business that NVIDIA is in versus all these other giants, which have, if you look at the sum of the parts valuation, they've got multiple businesses. So really expectations are getting ahead of themselves, and there will be a point where, you know, it will be hard to just manage expectations. And I think NVIDIA probably is at that point, but look, they could come out and beat by double digits again because we know every incremental CapEx dollar right now is going towards buying the chips because there is literally a shortage of what they're making.
We'll get to China in 1 second, but Mandeep, do we have a sense of what the saturation point is for demand for all of these chips at this point, at the development that they're at?
I mean, you go back in time, you know, with chips, typically there is a digestion phase. And right now, the customer base is incredibly concentrated for these chips. It's your hyperscalers, your Microsoft, Google, Amazon. These are the biggest customers of NVIDIA's chips. And they're buying because of their cloud business. But at some point, it has to translate into revenue numbers for these companies. And right now, we know Microsoft is the only one that has quantified the revenue impact. The others are still developing that capacity because they can afford to keep buying it. But I think the margin impact is crucial, because if NVIDIA's margins have grown 10%, it's coming at the expense of some other player. It's either the software players or like further application layer. And that is where you have to ask yourself, how long can they sustain that margins and at whose expense it's coming?
And then how many places can they be selling these chips? You mentioned China. What exactly are people looking for and skeptical about with respect to NVIDIA's sales in that country?
I mean, they have a 20% revenue exposure. And right now, the way they're trying to sustain that business, they're not trying to grow that business. I think their main thing is at least it should not be a hole in their growth numbers. And they're just coming up with a lower spec chip to make sure they comply with those regulations. But literally the focus on, them sustaining that 50% growth is on other regions outside of China. And remember, their customer base is concentrated. So it's really 8 or 10 companies that's doing the bulk of the buying. I mean, if the governments start to buy them, that would be huge. And that is where, the positive catalyst could come from. But right now, I think the customer base is incredibly concentrated for NVIDIA.
Well, Mandeep, to maintain that presence in China, they're going to be coming out with a new China card and chip that basically usurps these U.S. export controls. But how long will that last, given the fact that there's growing competition in China for the higher-end chip processors?
Yeah, no, that's a great point. And look, I think with China, they're buying those EUV machines, they're setting up fabs. They really want to compete, at the manufacturing level in terms of manufacturing these accelerators and custom chips. So clearly, if you start looking out 2 to 5 years, it's a hard case to make that, NVIDIA will still have the pricing power in chips where everyone is trying to develop a better chip or same spec chip that NVIDIA has. But right now, they still have the chips that no one else can make. And that's why you see that in their pricing power.
Mandeep, I just get the feeling you think this might be a Southern News event a little bit later on this afternoon.
I mean, anytime you see a multiple expansion like that, and as I mentioned, Alphabet generates $70 to $80 billion in free cash flow. NVIDIA's revenue currently is $60 billion. Yes, it is expected to grow to $100 billion for data center. But you have to ask yourself, there is a company that's generating $80 billion in free cash flow that's trading at a lower market cap. And I think that's where investors will start to think, how long can they sustain these kind of margins and growth? And it will be hard to grow off a larger base.
Phenomenal
run. 3-4 quarters back.
Just phenomenal over the last 12 months. Mandeep, thank you, sir. Looking forward to your coverage for the next day or so. Mandeep Singh there of Bloomberg Intelligence. Their stock is negative again in the pre-market. Just 3 days of losses, just building up over the last 3 days. Down again this morning on NVIDIA, going into the earnings a little bit later on this afternoon. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. is said to have told allies that Russia could deploy a nuclear weapon or a mock warhead into space as early as this year. Sources say Moscow is developing space-based capabilities to knock out satellites. A nuclear warhead in orbit would violate the 1967 Outer Space Treaty, to which Russia is a signatory. Russia says it has no plans to deploy nuclear weapons in space. Amazon shares up in the pre-market. It will be added to the Dow next week and will replace Walgreens Boots Alliance. Meanwhile, in the Dow Jones Transportation Average, Uber will be replacing JetBlue. Citigroup boosting CEO Jane Fraser's pay by 6%. That will make it $26 million. She's initiated what's billed as the largest rework of Citi in decades. The aim of that reorg, propel the firm from banking underdog to serious competitor. That's your Bloomberg Brief, John.
Danny, thank you. TK just wrote in. Really, Mal. He's woken up. He's coming to the office. Got into the office about 15 minutes ago. Thank you, Tom. Says this, massive Dow analysis today. It is insane.
Well,
massive Dow analysis.
We knew this was going to happen. Well, we've analyzed it. Now we're done.
Boomer Radio kicking off in about 16 minutes' time with TK on massive Dow analysis. Looking ahead to that. Up next on this programme, making a case for the Fed's first cut.
I thought we'd have 3 cuts this year, May, June, July, 25, 50, 25. I'm probably going to dial back on that. But part of my thesis was the Fed is not going to want to cut in September or November because it will look like an election manipulation issue.
That's coming up next on the programme, live from New York City. This is Bloomberg. TK sending me so much hate mail already. Equity futures right now on the S&P, negative 5.2%. Yields are lower by about a basis point, 426.16. Under surveillance this morning, making the case for the Fed's first cut.
I thought we'd have 3 cuts this year, May, June, July, 25, 50, 25. I'm probably going to dial back on that. But part of my thesis was the Fed is not going to want to cut in September or November because it will look like an election manipulation issue. So I think they're going to have to be very cautious about what they do in and around the election so they're not in any way portrayed as affecting the election outcome. So if you take September and November off the table, yeah, maybe you only get 1 or 2 cuts and that's it.
It's the latest this morning. As hot inflation reads push back expectations for the first rate cut, former Fed economist Claudia Sahm thinks they should be cutting rates already, writing this in the Financial Times. The longer rates stay high, the more the Fed risks seriously damaging the economy. Now is not the time for the central bank to drag its feet on rate cuts. It's the time for the Fed to get out of the way. Claudia Sahm joins us now for more. Claudia, let's get straight into it. This was a brilliant piece. And slightly controversial given the prints we had on CPI and PPI last week. So let's go from there. Why do you think they're at risk of doing real damage to this economy, given the strength we saw in 2023?
The best way for the Fed to proceed is gradually, right? It's much worse for them to get into a crisis and have to cut 200 basis points all in one day. My argument is disinflation is here. We made massive progress this year. Regardless of what happened in 1 week, when we looked at January, 2023 was a big step forward, and the Fed is well into restrictive territory, 25 basis points every other meeting. Just do something gradual because they really are pushing. They do not necessarily have the luxury of time, given the strength of the economy. It may not stay.
What gives you confidence that we can just shrug off the CPI and PPI prints we got last week?
So I shrug nothing off, and the Fed doesn't either. Yet there were a lot of anomalies in this data and a lot of signal, right? Like it was a bad week. Legitimately, it was a bad week. Chair Powell in 60 Minutes told us they want more data. The data need to be good, not better, and not as good necessarily. Now, you're going to have to squint it last week and say it's, good, but not as good. And yet there are a lot of January effects. There were a lot of anomalies in that data. We need to see more. And yet we should not overreact to 1 month of data. Markets, in my opinion, really did. And I don't think the Fed did. They look through a lot of the noise.
Did the market overreact? This actually is an interesting point, given the fact that bonds really did sell off and you did see yields go higher. But stocks held in there. And if you look at stock analysts, they're saying the reason why we're seeing such strength is because consumers keep spending, companies' earnings are going up. If you look at the on-the-ground analysis, it kind of backs the strength that looked like it might have been underpinning some of those numbers. Why do you think that's not an accurate reflection of true strength that can sustain regardless of when the Fed cuts rates?
So the Fed is going to primarily look at how it's working through the interest rates and when the cut's happening. What I point to last week is the Fed has gone all in on data driven to the point that every time we have a data release, you see market movements, at least in the bond side of the markets. And we saw, the probabilities move out for a cut on Monday. Then they came back on Thursday when we got retail sales, and they went back out on the personal producer index. I mean, we should not have those kind of gyrations. And I saw Mary Daly speak on Friday after the PPI came out, and she's like, my thoughts about a rate cut haven't changed this week. Right. So the Fed is steady as she goes in many ways, and it's creating, I think, a lot of volatility. And like you said, there's disagreements between bond markets and stock markets. The last thing we need right now is confusion in financial markets. We got to get this thing on home. And it's just the data are going to be noisy, and the Fed has not given a lot of guidance on how they look at data. Right? They've just made it they put too much on the markets to interpret.
It's such a good point, Claudia. That's the communication of the Federal Reserve. Let's talk about the communication coming out of the White House. We've talked about it on this program so many times. We've talked about it together. Sometimes I'm just shocked that when you get really, really strong numbers coming from the economy, it's like tumbleweed at the White House. It's a struggle to get access to someone to talk about how decent sometimes these numbers are. You've written this morning in Bloomberg Opinion that Bidenomics is an easy sell if presented broadly. Claudia, can you give us a better idea of how you think this White House should be presenting some of their achievements?
I know it will be a shock to everyone, but I am a big fan of straight talk, right? And you have to go all in on your accomplishments and not pussyfoot around them. One important point that I made in the piece is, where is Biden talking about his win on gas prices? Right? They did so much to get gas prices down after Russia invaded Ukraine. They made so much progress to undo OPEC really pulling back, slow walking the production increases. And then they also put a green energy policy together. Like, it's the whole package, short-term relief, long-term relief, and it is absolutely crickets from the White House. Like, you don't have a lot of wins on inflation, take the wins you got. So I really don't get it.
Well, the one big win on the latest inflation data was the fact that the gem was that energy prices were so subdued, and that was because of gasoline. When it talks about Biden and communications, a lot of Americans, Claudia, don't even know what the Inflation Reduction Act has in store. If Biden himself is not going to be able to sell it, who should be selling that to the American people?
Biden has to sell it. I mean, at the end of the day, you can have all kinds of people like me out there jumping up and down saying, hey, that was great policy. And I do it because it is great policy, not because it's red or blue. And they have to go all in on this. I worked on a lot of Bloomberg opinion pieces last year where I wrote about different aspects of the rescue plan. Every time I sat down, I learned something. I'm an expert. I should not be learning from doing background reading. Like, it ought to be all out there. So it's too timid. I mean, you're going to upset people, and you're going to have people argue back that you're just making it all up, but you're not. So if you have facts on your side, you ought to get out there and fight with the facts.
And what about the fact of the large federal debt? We got latest projections from the CBO. It is not getting any better. Jay Powell says it's an urgent matter. Isn't this something that many point to Bidenomics as the cause of?
So we've been gnashing at the teeth for decades about the size of the federal debt and its unsustainable path, and nothing has changed. Right? We know the economics behind this in terms of programs, particularly entitlements, Social Security, Medicare, that could be changed some to get, their cost growth less under control, if one thought that was necessary. And yet just arguing over some big number and it's sustainable, unsustainable, that is not helpful. And frankly, if you look at the federal debt, it has come down ever so slightly during the Biden administration. Now, I don't want to ding the Trump administration because they were the ones that went, and Congress in a bipartisan way went way in on the COVID fight with CARES and other measures. So that's not, but Bidenomics has not cranked up the federal debt. So facts are great. Let's bring them.
Claudia Sam, we've got to leave it there. It's wonderful to hear from you. Claudia Sam there of Sam Consulting, giving us a lot to think about. So let's deal with the two issues. One, the Federal Reserve. Claudia thinks they should be cutting right now, or yesterday, or last month. And then the issue around Bidenomics and the lack of communication. The fact that we don't hear from them often, I find really, really confusing. I think we saw it with Brian Deese when he was the National Economic Council director. Was a struggle to get engagement from him. It picked up towards the end and then he left. Then we've had a replacement who we've barely heard from whatsoever. And I always talk about this with the payrolls report, and this is just an observation of being here for the last decade or so. Every single administration here that I've covered has always put up someone prominent in the White House, an economic advisor, to talk about payrolls every single first Friday of the month. And they've always got a story to tell, and you challenge them in a robust way, and they'll carry on appearing every single month to talk about that story. Larry Kudlow turned up every single first Friday of the month, and it didn't matter how bruising our conversations were. He'd be back the following month to talk about how strong he thought the economy actually was. I don't get that from this administration at all.
I'm not going to speculate on exactly why that is. What I find interesting, though, is the split in the Democratic Party. There are splits in the Republican Party, there are splits in the Democratic Party about what that message should be. There's a question around whether you recognize the pain that people are feeling for paying the greatest proportion of their incomes on food going back decades, or do you say things are really good? You guys should be feeling it, right? This is the tricky thing at a moment where there is not very much agreement on economic policy, oil policy, et cetera, within the Democratic Party.
I think to Claudia's point, what you see from the president, he's going out and talking to voters directly. The campaign is now getting on TikTok. What it feels like is he campaigned from a basement the last time around, and now it feels like he's going to be campaigning around traditional media. That is my take, especially given signals like not sitting down for the traditional Super Bowl interview.
And less comments on cookies and stuff like that, It's your opportunity to talk about lower gasoline prices, and you're talking about... I don't want to see that.
Come on, please.
Not doing a Jon Stewart impression. Not doing that at all. In the next hour, Cameron Dawson of New Edge Wealth, Mike Schumacher of Wells Fargo, and the Marriott president and CEO, Tony Capuano from New York City. This is Bloomberg.
consumer has been trading down.
But you can certainly see that there is some stress on the low-end consumer.
Consumer discretionary category is expected to show improvements for all of 2024.
I think the consumer is a little bit more stressed than what they were before.
If the consumer starts to roll over, then I think we go back to talking about recession.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowicz, together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500. It's down about 0.2% on the S&P after a couple of days of losses, going into the big earnings report a little bit later. The last couple of days, though, the upgrades to the previous upgrades. Need to talk about them right now. UBS raising its S&P 500 price target for the second time since December. Only a few days since Goldman Sachs did the same thing since late last year. David Costin at Goldman looking for 5,200, saying it's all about the earnings. And Lisa, Jonathan Golub at UBS now looking for 5,400, saying they quite simply weren't bullish enough.
Which is the reason why you're probably going to get more of the same, especially as we climb past a lot of the targets that people had previously. Is it coming, though, from big tech, or is it coming from the rest of the complex? And if it's coming from the rest of the complex, as we were hearing from John Stoltzfus earlier, then does it really matter that much with NVIDIA? I mean, yes, it does, but everyone's been saying it's the make it or break it stock. Goldman Sachs saying that this is the most important stock in the whole world. It is at this moment, but is it going to be just sort of, okay, they keep doing their thing.
I love how nervous you are about saying anything about it, just in case it blows earnings estimates out of the water.
Don't call
a little
me
bit
out
later
on
this
that.
afternoon.
Come on.
I can just hear it. I do it sometimes too. I can just hear it in the voice.
You're not
know
wrong.
that someone's going to watch this show back at about 5 p.m.
100%.
this afternoon and be like, Bramo, what were you saying about NVIDIA? NVIDIA, AMH, the big one, a little bit later.
Well, Barron's has most closely watched earnings report they've had in their 3 decades. So, to Lisa's point, yeah, you need to be watching it. I am interested about what NVIDIA has to say, what Mandeep was talking about in China, maintaining their presence in China. How long can that last given the competition? And where is the growth coming from? But I got the sense from Mandeep, I think, Jonathan, you got the similar sense. He would say today would be a seller of that.
He said basically, and my word's not his because he danced around it, he just gave me the impression that he thought today was a sounder news event for this stock, that we've gotten so used to double-digit beats and raises that this market, you could sense it in this market too. I mean, look at the price action over the previous 3 days with NVIDIA, softer this morning, lower.
Here's the issue, profit margins. How long can they keep charging premium charges to companies that are cloud computing operations that are going to be pushing back at some point? That's really going to be the main issue that people are looking for. I just want to know, is this really going to make or break the entire world's market? I mean, this is basically what people are saying, and that's the reason why I was pushing back on that, because more and more people who are bullish are saying there's a broadening out. Does somehow that narrative completely get upended if NVIDIA disappoints?
AMH was mentioned in China. Is it easier to talk about Chinese equities? Given that you know that people can't sell at certain times of the day now. If you are just joining us, I want to do this story again. I think it's absolutely amazing. Based off some of our reporting here at Bloomberg, China is banning major institutional investors from selling more shares than they buy during the first and last 30 minutes of trading. They're reportedly going a step further. They've created a task force with the nation's stock exchanges to monitor short selling and issue warnings to firms that profit from the wages. So it's okay to lose money on shorts. You just can't make money on shorts.
The concept of markets in China is slightly different than in the United States. And that's sort of one of the factors behind why some people are saying it's uninvestable, and maybe one of the reasons why it's lagged behind. The idea that if you're a quant fund and you happen to sell suddenly, you get banned from trading for 3 days, might raise concerns about the ability to play in this market. I'm just saying, theoretically, because otherwise,
Sure.
maybe people like this as a trade.
That was the most diplomatic Bramo I've seen in months.
I'm trying.
Months.
Thanks.
It's a good try.
Good.
Equities right now, negative by 0.2% on the S&P 500. In the bond market, yield to look like this, down a basis point, 426.16. 108 on the euro, basically unchanged. That currency pair negative by almost 0.1%. Coming up this hour, in just a moment, we'll catch up with Cameron Dawson of New Edge Wealth, looking ahead to NVIDIA earnings. Later on in the hour, Anthony Capuano, the Marriott CEO, on the state of the US consumer and a whole lot more. And we'll speak to Mike Schumacher of Wells Fargo on the Fed's path forward. This is refreshing. Why he believes we haven't priced in enough easing, Lisa. Not someone who thinks we've priced in too many cuts. He does not think we've priced in enough?
He thinks once they start, it's going to be 200 basis points, boom. And sort of this is a question, why are they going to start? If they're going to start just simply because of disinflation, are you going to see 200 basis points, boom? Or are you going to see something that's more measured? Or is there weakness down the pike? And that's really one of the big divides right now.
Mike Schumacher later this hour. We begin this hour with our top story. Tech pulling stocks lower ahead of the big earnings report of the quarter. Nvidia coming up after the close. Cameron Dawson of New Edge Wealth writing this. Tech does appear to be losing a little momentum. It has had many of these moments over the past year, with each digestion pulling back to trend and then rebounding higher. Cameron, I'm pleased to say, joins us now for more. Cameron, great to catch up with you as always. Just how important is this release a little bit later?
It's certainly important in the context of sentiment, because we do know that it has enlivened a great deal of bullish sentiment. You look at flows into tech, and they've been absolutely extraordinary from a sector basis. Every other sector has had either flat to outflows, whereas tech has gone through the roof. It's also very expensive, so it means there's a high bar for upside surprises. You note, though, that tech is still in an uptrend. So we've had these little sell-offs. They pull back to trend and then keep on marching higher. The question is, does this digestion period actually lead to a more prolonged period of digestion where the uptrend might be challenged? That remains to be seen.
We joked in the previous hour it's 4% of the S&P 500 and 99% of the enthusiasm to buy stocks. Does it really set sentiment that much for you?
We would hope not, but I think that at the end of the day, it's the encapsulation of so many hopes and dreams within this market. If we think about it as the effective, it's all about productivity and how much we're banking on the idea that you can see margins being up to so much that you can see a cyclical upswing. So much is being distilled into this one name that clearly, if you do see a disappointment, people might be a little bit less willing to bank on that big upside.
So from your perspective, how do you trade around this, given the fact that you don't want to knock this sort of incredible powerhouse? At the same time, you're getting a little nervous.
I think that we have to be very disciplined about chasing the market too much here. Given the fact of where positioning is, we know it's now into the extreme or stretched territory in aggregate. Valuations being stretched, sentiment being stretched. None of these things necessarily mean anything about short-term returns, but they are very powerful for 2-3 year forward returns, which just says that you have to stay disciplined about valuations. You can't chase. Doesn't mean that there's not opportunity. There's lots of opportunity within this market. It's just that those very expensive areas are places where you need to ask yourself, is it justified?
How much is this nervousness about going with the crowd? I mean, we heard that from John Stoltzfus, this question around he gets nervous when everybody comes to him. And I know that you've been more cautious for quite a while. And now you're sort of saying, well, you can't knock some of the valuations, you can't knock some of the earnings. Does it make you nervous that everyone seems to be flowing in the same direction, but you can't argue against it?
Well, our caution, the way that we expressed it, was by being neutral equities and focusing on quality, to say that we want to be invested through a cycle, and so remaining fully invested, but focusing on very specific parts of the market. But the point on positioning is very important, because we have seen multiple times in recent years where positioning becomes a risk in and of itself. Look back to 2018, look back to early 2022. When you get to the point of max positioning, everybody on the same side of the boat, the market has a very high bar to jump over, and it does not take kindly to downside disappointments.
Looking ahead to Nvidia, worried about downside disappointments. Let's talk about the economic data. Upside surprises last week. Hot CPI, hot PPI. We were talking about it earlier this week, late last week. Whether that is good or bad news for this economy, good or bad news for this market specifically. UBS's Jonathan Golub wrote this yesterday. The market sold off on that data. Quote, our work indicates these demand-driven readings are constructive for future returns. Is that hot inflation data good or bad news for this stock market?
Typically, higher inflation is better for corporate earnings. Revenues are nominal numbers, so higher inflation would suggest better revenue growth. But what I'd say to this earnings-driven upside is show me the revisions. We have not seen earnings revisions be broad. They're all concentrated in the Mag 7. Earnings for the Mag 7 are up 25% over the last 6 months. For the S&P 500, earnings revisions are flat. But for the equal weight, that average stock, they're down 5%. So we can talk about all this great economic data, but at the end of the day, the market is narrow, not just in its leadership, but in its earnings revisions. So we'd like to see that translate into better earnings, not just for a couple of names.
Which raises the question about which data to pay more attention to. John's talking about CPI and PPI, but retail sales came in really negative, a lot weaker than expected. We're about to be speaking with Tony Capuano, the CEO of Marriott. What are you curious to know about the consumer that you see that's been raising some alarm bells for you?
There is one wrinkle in the consumer data, and it's delinquencies. And I would love to know if delinquencies are a sign of trouble to come. It's very rare that you would see delinquencies move up as much as they have outside of a recession and during a time where the labor market is actually tight. So when we look at overall consumer, we say still healthy, but what does that rising delinquency say about stress, maybe in the lower end of the consumer where you're really starting to see them get pinched?
Final question. Do you want to buy the Open in China tomorrow?
Yeah. Well, I know I can't sell it.
Does it get easier now? I do wonder, does everyone just sort of bid up things at the Open?
I don't get the sense that that's necessarily the response. Cameron, you could weigh in. Is that sort of the response that you would do, is just pile all in China?
There's just so much uncertainty from a policy perspective. I think we've said it is that we're not in the business of catching falling knives in highly uncertain regulatory environments. So China's a tough one, but we do ask the question, we're underweight EM. At what point do we need to reconsider that, given that China is such a big weight in the emerging market index?
It's like Hotel California. You know, you can get in, but try getting out.
Quite literally, you can't.
Exactly. So that sort of raises this question, right? And Cameron just answered it.
Cameron, thank you. It's good to see you. Cameron Dawson there of New Edge Wealth. Broader equities, stateside, equities right now. Are we going to do China equity checks anymore over in Asia? Will we carry on doing that?
Well, sort of like, quoting Bitcoin.
Equities right now on the S&P are negative by 0.2% on the S&P 500. To think we spent the last 10 years people complaining about central banks and rigged markets. Look at what's going on over there.
Okay. Well, hold on a second. When you talk about rigging markets, there are other levels of rigging markets. There's banning of short selling. There's owning the entire market, if you look at Japan.
There's just banning selling.
There's banning selling. There's quantitative easing. There's buying swaths of bonds. There's all sorts of manipulation we can talk about.
Absolutely. It's been a story of the last decade or so. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. plans to unveil sanctions against Russia on Friday following the death of opposition leader Alexei Navalny. President Biden blames Putin for the death of Navalny, who had been imprisoned in the Arctic. While the White House says the sanctions include a substantial package of financial penalties, which target Russia's defense and revenue sources. Hedge funds pared exposure to Mag 7 in the fourth quarter, say Goldman Sachs. The firm looked at more than 700 funds with $2.6 trillion worth of equity positions. The only Mag 7 stock that saw an increase was Amazon. HSBC shares are falling. Fourth quarter profit plunged by 80%. The bank took a $3 billion impairment charge on its holding of China's Bank of Communications. CEO Noel Quinn also announced a $2 billion share buyback. It was supported by higher global rates, but HSBC is still facing headwinds on one of its key markets, China. That's your Bloomberg brief, John.
Hey, Danny, thank you. Up next on this program, the state of the U.S. consumer.
The consumer has been trading down. I mean, we do continue to see that. It doesn't mean it's all bad for the consumer out there. I do think that the consumer is choiceful, as Walmart said, and it has been able to spend where needed.
That conversation just around the corner, live from New York City. This is Bloomberg. Equities on the S&P 500 negative here by 0.2%. Slight pullback on the S&P going into that big earnings report after the close a little bit later. Nvidia is just around the corner, the number one performing equity on the S&P 500 last year and this year as well, year to date. Yields are lower by a couple of basis points on a 10-year, 4.2537, and the euro slightly weaker, 108.02 against the dollar. Under surveillance this morning, the state of the US consumer.
The consumer has been trading down. I mean, we do continue to see that. It doesn't mean it's all bad for the consumer out there. I do think that the consumer is choiceful, as Walmart said, and it has been able to spend where needed. 2024 is looking to be more of a year of normalization. And the year's starting on probably going to start somewhat soft and hopefully pick up a little bit as it progresses.
Here's the latest this morning. Earnings reports from retail giants Walmart, Home Depot suggesting weakness in the US consumer, but the travel sector showing a little bit more optimism. Tony Capuano, the president and CEO of Marriott, saying this on the latest earnings call. The demand for all types of travel remains strong, even as the rebound impact from the pandemic has waned. I'm pleased to say that Tony joins us now and he'll be with us through the hour. Tony, good morning to you.
Good morning.
8,800 properties, 139 countries. You've got a decent line of sight into the global consumer. The story we've heard a lot about is US strong, rest of the world not so good. Do you see it the other way around in your business?
Yeah, I don't know that I would say the U.S. is weak. I think the U.S. has reached a normalized environment a little more quickly. If you look at the experience we had in our business last year, we saw global RevPAR, revenue per available room, which is the metric that we use to evaluate the strength of the business, increase about 15%. Single-digit growth here at home in the U.S., strong double-digit growth internationally. Now, some of that is because those markets opened a little more slowly, so they benefited from easier year-over-year comparisons. But even as we look into 24, we guided on our earnings call 3 to 5% global RevPAR growth this year. Again, disproportionately stronger international.
Let's sit in international just for a moment. So UK economy's contracting, Germany arguably in recession, Japan in one, China struggling. You don't see it in quite the same way, and I find that really, really interesting. Are you seeing a bounce back there? What do you actually see, in which region are you more constructive on?
So Asia broadly is really strong from a travel perspective right now. We think about Asia in two buckets, if you will. What we call APEC, Asia Pacific excluding China, and then Greater China. Greater China is fully recovered to pre-pandemic levels, although interestingly, largely on the shoulders of domestic demand. If you look at cross-border airlift, it's only about 60 or 70% recovered to pre-pandemic levels. So we actually think there's still a fair amount of upside to the China recovery story as more and more cross-border travel recovers. I'll be in China in 2 weeks, and I'm anxious to see how it feels in terms of international travel. I was there maybe 9 months ago, and it felt very domestic. I was in markets like Changsha and Chengdu, and felt like I was one of the few international travelers. So it'll be quite interesting. When you look at the APEC markets, they are booming. Thailand is very strong. Singapore is very strong. I was just in Vietnam, really strong both from a development perspective and an inbound travel perspective. And the last comment I would make, you've seen China create some visa-free travel zones across the APEC region, and that's really impacting demand patterns.
I have to go there. We talk about banning iPhones. Is there a problem with staying at a Marriott hotel in China?
No. It's our second largest market. We just opened our 500th hotel in China. We've got another 400 hotels in the pipeline behind that. The vast majority of our portfolio is China-owned. The vast majority of our workforce is Chinese. So we see great strength in our China business.
Moving forward, I am curious about where you see the demand coming from. I know you've been expanding into mid-scale, extended sale, mid-scale types of accommodations. Is that because you see the growth in actually lower income and medium income families and not as much in the luxury sector?
That's a good question. My view is it's not binary. We have the largest luxury portfolio in the industry. We have more than 500 luxury hotels globally, another 250 in the pipeline behind that. We saw revenue per available room in the luxury portfolio actually grow 10%. I was listening to the prior segment and hearing about trade down. We're not seeing that from luxury. Luxury continues to be a really strong segment for us. Our entry into mid-scale is really intended to open the aperture. Our objective simply is to try and capture as broad a segment of the traveling public as possible, and entry into mid-scale just allows us to capture a broader segment of the traveling public.
Can I ask you what is mid-scale? Can you describe that? What is the difference between, say, mid-scale and luxury? And what do you call the other end of the scale?
So luxury is obviously from a physical product perspective and a service delivery perspective, everything you could hope for. Mid-scale, simply put, cheap and cheerful. right? Simple, high-quality facility, but simply delivered. Minimal services, great bed, great shower, great Wi-Fi, but relatively limited services.
When you're looking at that mid-scale, your competitor IHG was on yesterday and talked about next 10-year projections. U.S. middle class will grow 100 million. China's middle class, 200 million. When you look at building out the middle class around the world, where is it? Is that in China?
It's everywhere. I mean, I think across Asia you see really strong growth in mid-scale. You see it here in the U.S. And that consumer, we want to get them exposed to the breadth of our portfolio early. We've got nearly 200 million members in our loyalty program, Bonvoy. By entering the mid-scale segment for the first time, it gives us the ability to show a segment of the traveling public the breadth of the portfolio who perhaps isn't aware of the 30 brands that make up Marriott today.
All I can say is that side of the table is the luxury side, and this is the cheap and cheerful side.
See, I can take you off.
Yeah, exactly. It's sort of a question of.
I love it. Tom's not here anymore, so you beat up on me instead.
Well, I mean, am I wrong?
Tom would be on that.
I know. I miss talking about Venice with Tom.
No, it's fine.
I'm not going there.
Let's move on. There is this question, though, about what Cameron Dawson was saying, which is we are seeing delinquencies tick up. We are seeing retail sales come in weaker than expected. We are seeing signs of cracks on the margins. Are you not seeing it? I mean, yes, because you're offering a wonderful product and et cetera, but is it partly because people continue to prioritize travel in a way that they just didn't before the pandemic?
I think that's exactly right. One of the great benefits of our credit card partnerships with JP Morgan Chase and American Express is we have really deep insights into that consumer spending. And even prior to the pandemic, what we saw maybe with younger demographics was a shift towards or away from spending on hard goods towards spending on experiences. It appears when we look at that data today, the pandemic acted as an accelerant to that trend across demographics. And as a result now, perhaps the consumer saw or learned during the pandemic, I didn't buy any purses, I didn't buy any watches, I didn't buy any shoes, and I didn't miss it that much, but I sure missed traveling. And so I've prioritized that disposable income I have, and I am seeking the vacation that I missed, the family reunion, the wedding, the trip with friends, whatever it might be. And so we really don't see that decline in travel spending in the data. We just reported fourth quarter and full year earnings, highest EBITDA in the history of the company, as I mentioned, 15% RevPAR growth. Really extraordinary numbers. And what was encouraging to me, the strength we saw was across geographies and across demand sectors.
I miss the service. Can we talk about that? I'm not talking about Marriott now, just for the record. I'm talking about hotels in general. You go in, the towels are there, they might be on the floor. I'm usually good about that. I'll put that on the side. I don't want to make too much work for people. But then there'll be this little card that will say something like, we're going green. So we're pulling back on washing things. And I say the same thing every single time I'm in a hotel room. Are we using going green as an excuse to provide less service than we used to at hotels?
Yeah, I think that would be a fair view if you didn't have optionality. And so if your view is, I want fresh towels every day, I want my bed remade every day,
we can still get them.
You can absolutely still get it. But
Yeah,
what we
guilty.
hear from our customers more and more is they want the ability to contribute sustainability and have sustainability be a part of their travel choice.
At the high end? At
Really
the luxury
across
scale?
the board.
Interesting. All right. I rule myself out personally. I think that when I go and you spend that much money, you...
Towels at the St. Regis?
No, I'm not getting into that. If you go to a hotel, five-star hotel, you spend real money to go and stay there, you want fresh towels, fresh sheets, don't you? Isn't that a whole part of the experience?
I don't need to go into.
How often do you wash your towel at home?
At home. Every couple of days, a fresh towel. Every couple of days.
Honestly, I can reuse my towel because I feel like I'm obligated to.
It's the
participate.
conversation I didn't expect, but ultimately I'm getting to the point about service. Don't you feel like service has pulled back since the pandemic?
Oh, without a doubt.
do.
It has been. And it's been sort of an open, not secret, because frankly, there wasn't the staff, which raises this question of whether you can hire enough people and what kind of people you can retain over a longer period of time. It's a good question we can get into.
Yeah. Although one of the things that's been interesting when you've watched the employment reports over the last number of quarters, you see that hospitality has been a disproportionate contributor as our industry sector staffs.
Very true. And I'll say this for the record, staying at my house is not $1,000 a night. Tony Capuano of Marriott International sticking with us from New York City. This is Bloomberg. Honestly, the comments I'm getting in the commercial break, this on the Bloomberg terminal, you care more about getting a fresh towel than saving our planet at the hotel. Absolutely. I'm not even disputing that. Bramo wants to know why breakfast is better abroad than it is stateside. More still to come on this programme. Equities right now on the S&P 500, negative by 0.2% on the S&P. We're down 0.4% on the Nasdaq 100. In the bond market, 2-year, 10-year, 30-year. Lots to talk about around the Federal Reserve in the next 24 hours. Tons of Fed speak. Yields are lower by a couple of basis points on a 10-year, 425.37. Down 3 on a 2-year, 458.27. In foreign exchange, I'll just finish on the euro for you. The euro looks like this, negative by almost 0.1%. Let's call it 108 flat, almost totally unchanged on the session. Under surveillance this morning, the number one stock of the year. Nvidia's much anticipated earnings coming after the close today. The stock jumping more than 40% so far year to date, driving it to a market cap of more than 1.7 trillion US dollars. Booming AI spending driving the chip maker past sky-high expectations for several quarters now. And analysts again have lofty estimates for the company, forecasting sales more than tripled in the fourth quarter. Lisa, what's amazing, we keep raising the bar and they keep beating it.
Because who else is the game in town? Everyone keeps hoarding these chips. But the reason why people say this is the most important stock in the world, it dropped 4.4% yesterday. That is equal to a market capitalization of $79 billion. So if you start talking about a drop like that in a penny stock, it can move any kind of, difference. But if you're talking about a 4 or 5% swing in a name that's this big, all of a sudden you're talking real money.
Tony Capuano with us from Marriott through the next hour or so. We're going to talk about AI just a little bit, Tony. How is this changing your business? This is moving so quickly for us around this table. What's changed for you?
Yeah, so, we've used elements of AI in our business for quite a while. What's exciting to me about AI is its ability to create capacity for our associates. At its core, we are in a people business, the ability for our associates to interact with our guests. And if AI creates more capacity for them to engage our guests, person to person, that's a huge advantage. I was in Cork, Ireland a couple months ago at one of our big customer engagement centers. And one of the things I did is I listened in to customer calls. And travelers have become so sophisticated today. Some of the calls you listen to now, the customer calls and says, I want to go to a beach resort that has a Japanese and an Italian restaurant where I can get two bedroom suites that's less than a 20-minute drive from the airport. And so for our agents left to their own devices, that's a complex search for them to do. With the benefits of AI technology, they can do that search in an instant, and it gives them more time to help curate the experience for our guests.
How long before a robot cleans your bathroom and makes your bed?
And washes your towels.
And washes your towels for Jonathan Ferro.
Yeah, I hope they don't. It's funny. I had a group of MIT students come visit our headquarters in Bethesda. And I had a young student raise his hand, and he was so excited about AI. And he asked me, he said, can you imagine a day where you can run a hotel with no employees? And I said, gosh, I hope not, right? Because at its core, we are in the hospitality business. I think AI will create capacity for us. Of course, it'll create some efficiencies. It'll allow us to do a better job of helping our guests curate their travel experiences. But we're in the people business.
I couldn't agree more, and I'm so pleased you said that, and I hope that's the case, because I grew up in the hospitality business. My family did, and it would be so sad if we did to services with AI, with ultimately globalization did to manufacturing. If you start to really displace workers, and I think that would be horrific.
It raises this question, which workers are going to be the most necessary? What does high touch mean in a new era with new kind of tools?
It's the worry I think we all have about this particular technology. I want to turn to this. Citi handing Jane Fraser, the CEO, a 6% pay rise, lifting her salary to $26 million. The increase comes out of what's been described as the biggest restructuring in decades, with the bank saying it will cut 20,000 roles in a bid to boost returns. The bump falling well short of a counterpart at Goldman, David Solomon receiving a 24% raise there to take home $31 million. Tony, you'll escape this one. I'll talk to Lisa about it instead. Citi stock has done pretty well. Over the last 12 months, JP Morgan top of the pile, Second place on the street is Citi.
Well, I mean, they've been doing this incredible overhaul and cutting a lot of jobs and trying to streamline the units into 5 different sections. It is interesting that Goldman Sachs raised David Solomon's salary by 24%, even though profit dropped by the same percentage. You know, there is a real question here about pay equity, and we're definitely not going to ask Tony about this in any way, shape, or form. But, I mean, trying to put into perspective, $26 million, $31 million for David Solomon, James Gorman, $37 million. Looking at Charlie Scharf and also Brian Moynihan, both $29 million. It's sort of like, what are we talking about here?
You know who might have something to say about that?
Elizabeth Warren?
Elizabeth Warren, the senator from Massachusetts, with this to say on the Capital One Discovery deal. $35 billion Discover financial deal. On a post on X, this is what she had to say. The senator saying regulators should block the deal. Shock. Writing that it threatens financial stability, reduces competition and would increase fees on credit costs for Americans. Bloomberg's Mike Shepard joins us now from Washington, D.C. for more. Mike, I think we've all been asking this question. What deal would be allowed in Washington, D.C. these days, given the amount of deals that we've been told probably won't be allowed?
Well, that's a great question, John. And in thinking about our conversation, I took a look back at our own research from our newsroom on what enforcement activity by antitrust officials here in Washington has been. And in 2023, they set a record for merger enforcement activity. That means engagement with companies, and that means even going as far as trying to block deals. It's a great question about what could get through, not only what could get past the enforcers, but what also ultimately could get through the courts. Elizabeth Warren was not the only U.S. senator voicing objections about this deal. We heard from another progressive yesterday, Sherrod Brown, expressing his reservations and also calling for a strict review. He's up for re-election this year. He didn't call outright for blocking the deal immediately, but he is putting the feet to the fire of antitrust enforcers, including the FTC chair, Lena Khan, and her counterpart at the Justice Department, Jonathan Cantor, who heads the antitrust division, to do their jobs and to give this new deal that we saw yesterday. It is the largest announced this year at $35 billion, to give it a tight scrub.
It felt like there was a little bit of daylight between Sherrod Brown and Elizabeth Warren. He's saying they need to ensure the financial system remains strong and they want to look at this. Elizabeth Warren is flat out saying this should not go through. But, Mike, that wasn't the only deal she talked about. She also talked about Kroger yesterday, and the text from her tweet was, quote, "This merger should be stopped." And what we reported overnight is that the FTC is actually planning to do that.
Yes, that's right, Annmarie, and I'm glad you asked about our scoop yesterday. We reported that the FTC is preparing to sue to block this Kroger-Albertsons deal. It's a $24.6 billion tie-up of these two giant grocery store chains. And the concern, which has already been aired by some state attorney generals, is that it will hurt workers. Unions have voiced their objections about what it could mean for their workforce in these stores. But they're also saying that it could hurt consumers, that the pricing that we've seen at grocery stores over the past few years, concerns about eggs and milk and everything else costing so much, that we're not going to see any break on those prices because the supermarkets won't have any competition incentive to lower those prices for consumers when they're looking at the shelves.
That's the argument currently. Shepard's going to catch up. Michael Shepard there, down in Washington, D.C. Tony's still with us. Tony, let's talk about politics. This will be the worst of this conversation, I promise you. So Choice Hotels is after Wyndham, and they're basically saying that this shouldn't trigger antitrust because big players like you are going down market. What would you say back to that?
Well, I know what you know that's been reported about this potential acquisition. I mean, I think about the report we just listened to. The Wyndham board has reportedly indicated real concerns about the regulatory challenges of a deal like this. Certainly, that deal, when you contrast it with the deal we did with Starwood, which was a global deal across multiple quality sectors, a Choice Wyndham deal would be much more concentrated domestically and much more concentrated in the lower quality tiers. So given the current environment for M&A deals, it would, it's probably a fair assertion from the Wyndham side to question the regulatory challenges.
There's a question about how much you factor in the regulatory environment when coming up with expansion plans. How much you prefer to go organically rather than make acquisitions as a result of the fact that not a lot of things are getting through.
So it's interesting. All the big global brand companies have a different point of view about how to expand the portfolio. Ours has been a hybrid view, and I think time will prove that's been the right strategy. We talked a little bit about this on the fourth quarter earnings call. When I look back over the last decade, set aside Starwood, which was a transformational deal. But when I look at brands that we've added through bolt-on acquisitions like AC Hotels or Gaylord Hotels, I'm elated that we did these small M&A deals. At the same time, I think about the launch of Autograph Collection or Moxie Hotels, which were organic platforms we added. The combination of those two strategies has served us very well. And I think that'll continue to be the roadmap going forward.
Mike Shepard mentioned that last year for this administration, it was a record in terms of breaking up, a record in terms of antitrust enforcement. Do you expect the regulatory environment to change if we were to see a new president?
Yeah, it's a good question.
New president?
If President Trump comes back, I think the expectation broadly of the business community is it would be a pro-business environment, but it's anybody's guess.
Pro-business at home and maybe tougher abroad, which introduces the subject of China. Lisa mentioned it earlier. I think we need to go back to that and build on it. You remember back in 2018, the website in China was shut down. It was a mistake, an error, sending out, I think, an online survey at the time that listed Tibet, Hong Kong, Macau, Taiwan as separate countries. Got you in some hot water. As a CEO, as you know, sometimes you have to be a diplomat. Is it getting harder to be a CEO of a multinational company, given the political backdrop at the moment?
Yeah, it is. I wish I could tell you the world was getting simpler to navigate. We're in 139 countries today. We've got another 20 some odd countries in the pipeline coming shortly. So it is complex to navigate. The good news is the company will celebrate its 97th anniversary this year. Our founders founded the company on 5 core values, and those are the values that guide us. One of those core values is acting with integrity, and I think if we follow those core values, for the most part, that'll help us navigate this ever-increasingly complex world, but it is certainly challenging.
I'd love your view, just speaking about China. We talk about how businesses don't have conviction to go there, to make investments, to expand. We certainly see this in the financial space. We see this in the tech space. Why is it so different for Marriott?
Well, so, it's funny. I've had the opportunity to spend a lot of time with Secretary Raimondo. And I was thinking about your prior guest, who I know has some history in ballet. My wife and I were the chairs of the Washington Ballet Gala, and we had Secretary Raimondo as a speaker at our event. And she talked about the importance of countries finding common ground to keep the dialogue open. And she talked about the arts, and she talked about travel as relatively non-controversial areas where they can continue to talk. You likely saw when she came back from her official visit to China, she announced a joint U.S.-China tourism summit that'll happen early this year. And so I think travel is an area where there is some common ground between the countries, despite the complexities of the relationship. And that creates real opportunity for us for growth.
When it comes to geopolitics, before the COVID-19 pandemic, cybersecurity was the big issue for the hotel industry. And a lot of that had to do with this, and you were caught up in this Chinese espionage infiltration. Where's the industry now in terms of cybersecurity? Because now it's just not just China, it's Russia, it's actors in the Middle East.
It's a top priority for us. We make significant investment in doing everything we can to secure our cyber environment. We're coordinated with law enforcement. We're investing in internal resources. We work with the CrowdStrikes of the world. We do everything we can to harden that environment. But as I've heard you talk about on the program, there are a lot of bad actors in the world that are doing everything they can to try to penetrate those environments. And our objective is to secure our own data for our associates and our customer data, because we collect an extraordinary amount of customer data.
Tony, this has been great. You're going to stick with us. We're going to talk about interest rates in just a moment as well. Tony Capuano there of Marriott International. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg brief. Here is Danny Berger. Hey, Danny.
Hey, John. The U.S. is said to have told its allies that Russia could deploy a nuclear weapon or a mock warhead into space as early as this year. Sources say Moscow is developing a space-based capacity to knock out satellites. A nuclear warhead in orbit would violate the 1967 Outer Space Treaty, to which Russia is a signatory. Russia says it has no plans to deploy nuclear weapons in space. Shares of Glencore are falling after the company reported a steep drop in annual profit as prices spike and swings in commodity markets eased. The commodities giant also slashed its dividend to $1.6 billion for the first time in several years and did not announce a new share buyback program. Amazon shares, they are up in the pre-market. The e-commerce giant is being added to the Dow Jones Industrial Average next week. Amazon will replace Walgreens Boots in the index. Another change, Uber will replace JetBlue in the Dow Jones Transportation Average. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, Fed Minutes coming up.
The best way for the Fed to proceed is gradually. Just do something gradual because they really are pushing. They do not necessarily have the luxury of time given the strength of the economy. It may not stay.
That conversation up next, live from New York City this morning. Good morning. Another day of losses potentially on the S&P 500, pulling back just a touch. No drama. We're down about 0.25% on the S&P. Yields are down by a single basis point, 426.16. Under surveillance this morning, Fed Minutes coming up.
The best way for the Fed to proceed is gradually. Right? It's much worse for them to get into a crisis and have to cut 200 basis points all in one day. 25 basis points every other meeting. Just do something gradual because they really are pushing. They do not necessarily have the luxury of time given the strength of the economy. It may not stay.
Here's the latest this morning. The minutes from the Fed's January meeting due at 2 p.m. Eastern Time as investors look for guidance on when the central bank will begin to reduce interest rates. Traders seeing little chance of the Fed cutting before June after hotter than expected inflation data last week. Mike Schumacher of Wells Fargo thinks the market is now pricing in too little easing. When the Fed eventually does start easing, we think the market quickly will price in 200 basis points over the subsequent year. Mike Schumacher joins us right now. So, Mike, this is refreshing. Just as everyone starts to run to the other side of the boat, you're leaning in hard. You don't think we've priced enough easing. Why is that?
What happens is we're not really sure when the Fed goes the first time, and I think people are too fixated on that. Is it May? Is it June? Is it July? For most reviewers, it simply doesn't matter. The bigger takeaway is that once the Fed goes that initial time, I think people in the market will say, aha, they're in easing mode. It's a cycle. We know how cycles work. They usually go 200 basis points pretty quickly. We should price that in. And today the market's priced for, call it 120 basis points from June of this year to June of next year. Just not enough.
Are you more cautious then on the economic outlook and more optimistic the Fed will meet that weakness with more aggressive rate cuts?
Actually, our econ team is fairly positive. They think the U.S. economy has been underestimated for some time now. You look at the data the last couple of weeks, they've obviously been scary with non-farm payrolls, with CPI. Maybe they're quirky, maybe they're not, we don't know yet. But as far as the core trend of the economy, it's pretty good. But really, from the Fed standpoint, it's got a lot of room here. It's got Fed funds substantially above 5%. It's got real yields that are very, very high. It's a key point. The Fed's going to push back and try to say we need to take out some insurance against future economic damage. So it's not so much we worry about the economy today. We worry more about the economy in 12 months' time if the Fed doesn't come in fairly aggressively.
Mike, does this mean that you think that the inflationary pressures really were, I hate to use it, transitory, and that basically they are dissipating and we're going back to a pre-pandemic inflationary type of regime?
Probably a bit more aggressive than pre-pandemic. A lot of people have talked about nearshoring, onshoring. I'll leave that to your hotel guest. He can certainly speak to it better than I can, but I suspect that's going to drive the trend level, the equilibrium level, higher than it had been pre-COVID. But going back to something closer to pre-COVID levels. So maybe it's low 2s or even 2.5% for core inflation. Something like that on a run rate makes sense to us.
You set him up, so I'm going to go straight to him. Mike, we'll leave you there. Mike Schumacher there of Wells Fargo. Tony Capuano of Marriott still with us. So, Tony, you were the Chief Development Officer before you were the CEO. Let's talk about interest rates. What share of hotel owners right now are struggling or facing difficulties refinancing properties because of what's happening with interest rates?
So it's an interesting question. When we reported earnings, one of the things we highlighted We signed more organic rooms in 2023, 164,000 rooms, than in any year in our history. And so that might suggest to you that it's a vibrant growth environment. Our pipeline, our global pipeline, has over 570,000 rooms in it, another all-time high. But there's a couple caveats there. About 2/3 of those 570,000 rooms don't necessarily need financing. Either they're already under construction and financed, they are conversions of existing properties, so they don't require financing, or they're in a part of the world, much of Asia Pacific, Middle East, where they don't require conventional financing. Here at home, where about 90,000 of those 164,000 signed rooms are located, financing is clearly a challenge. It's less about interest rates. Of course, a higher interest rate environment squeezes the yields on new construction projects. But the biggest impediment right now, if I had been with you a year or two ago, I would have talked about supply chain interruption. I would have talked about the construction cost environment. Those are still issues, but they've faded a little bit. It's really the availability of debt financing for new construction. Most of our owners are long-term owners. They're not trying to time their construction start over a 1/4 of a point move in interest rates here or there. They're going to hold these assets for years, if not decades. But it's just the availability. There is, in the regional banking system and even some of the national banks, a concern about what regulatory requirements may be coming down the pike in terms of balance sheet requirements. And as a result, there's a reluctance for origination of new debt.
Which means that you're in a pretty great position when it comes to setting prices for rooms, because it means there isn't going to be a lot of other competition that's going to be built and brought to market. How much pricing power do you still have at a time where we really don't have a sense of what inflation is going to normalize to?
So in general, if you look over a long period of time, average daily rates relatively track with inflation. It depends on booking windows. So group business, for instance, tends to book a little further out. So there's a little bit of lag with inflation. But in general, over the long haul, we track with inflation. Average rates are part of the calculation of inflation. So we think we still have pretty good pricing power. What was interesting during the recovery, as you point out, we've enjoyed as an industry historic low levels of supply growth, particularly here in the U.S. And as a result, particularly in leisure destinations, we've had remarkable pricing power.
Away from pricing and just back to interest rates for one further question, if we can. How are you helping those owners that are struggling to refinance debt? Are you allowing them to defer CapEx, do fewer repairs? What are you doing to make the situation a bit more comfortable?
In the sort of the heat of the pandemic, we really came to the other side of the table with our owner and franchise community and did everything we could to help them navigate this existential threat to our collective business. We allowed, in some cases, we partnered with them to talk to their lenders about tapping into their reserves for furniture, fixture, and equipment replacement, to use that to help sustain them. We helped them negotiate extensions with their lenders. Now that business has recovered, we're helping navigate with them. Okay, many of these properties need capital reinvestment. And we're trying to, I wish I could tell you there was a formulaic approach. It really is much more bespoke. We're looking at the circumstances with each of those owners, each of those franchisees, what their operating track record has been, and trying to come up with an approach by product.
We've got about 60 seconds left. I want to squeeze in this question. The future of cities and the post-pandemic reality for some of them. Downtown San Francisco, parts of New York City. At times they're like ghost times. Some people might consider them to be crime-ridden as well. We won't get into the politics of that. We can just talk about the reality of it. Is it getting harder to stay in certain locations in this country now?
Yeah, so, I mean, it's interesting. I stayed here in New York last night. It was tough to get a room. New York is booming. New York is back. What we tend to see in urban markets, those markets that can benefit from this idea of blended trip purpose, where folks are tacking on a couple of days pre or post business travel for leisure pursuits. Those are the urban markets that have recovered most quickly and are thriving. Those markets that are really sort of traditional core business destinations that tend to get pretty quiet during the weekend, they have a longer road to recovery.
Hey, Tony, this was great. We should do it again. It's just
Anytime.
fantastic to see you.
I'll
Thank you,
bring
buddy.
breakfast next time.
We would love that from the St. Regis if possible. Thank you, sir. Tony
My
Capuano, the CEO and president of Marriott International. Coming up in the next hour, Binky Chadha of Deutsche Bank, Vijay Rakesh of Mizuho, Stephanie Roth of Wolfe Research, and Bloomberg's David Welch from New York City. This is Bloomberg.
Need the Fed to start cutting. We think that starts in June.
I thought we'd have 3 cuts this year. I'm probably going to dial back on that.
I think that they are sticking to their slower to lower interest rate mantra.
They've pretty clearly told us that they're not going to pull the trigger in March. So by the time May, June rolls around, we'll have a lot more data on everything.
The reality of the situation is they just continue to do nothing and promise they're going to cut rates.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Primetime Binky Chadha in the commercial break. We'll leave it in the commercial break, Binky. Deutsche Bank's Binky Chadha with us in just a moment. Look out for that. Live from New York City this morning. Good morning. Good morning. Equity futures on the S&P 500 lower here by 1/3%. Nvidia is coming up later. You know that already. It's the Fed minutes nobody is talking about. Literally nobody. So we're going to talk about it. They come at about 2 p.m. Eastern time. And a lot has changed since the Fed last met at the end of January. Lisa, we had a hot CPI report, hot PPI report, and a tremendously strong jobs report to kick off this month.
We also got about 25 Fed speakers. This raises this question, what more can they tell us it's really going to be different? That's going to be the balance sheet. That's what some people are looking at. Maybe that. I'm not going to get into that right now. The key question is the Fed out of the driver's seat? And it's in the driver's seat for the likes of Nvidia and earnings that really take front and center for investors who are being whipsawed by $80 to $100 billion just in a couple basis points.
It seemingly is exactly how you've put it. We've talked about this a few times, and I think you're right on the money. We've spent so much time talking about Fed policy, pushing back interest rate cuts, and yet equity markets are still doing okay. We've pushed things back from March out to June. I've got Mike Gapen's work in front of me from Bank of America. Risks are skewed towards a delay. Risks are skewed towards a delay, and yet still, stocks like Nvidia are up 40% year to date after a monster gain last year.
Two things. Nvidia is a secular shift, right? So a lot of people are saying this is the hopes and dreams. Cameron Dawson saying this is the hopes and dreams of the entire market pinned on one company with respect to generative AI. Then there's a question about the rest of the 499 stocks, right? There's sort of a question of the hopes and dreams of individual consumers and how much they still have and how much they'll keep spending. More of a question mark. Does it matter, though, if the hopes and dreams of NVIDIA just blinds us to anything else going on elsewhere?
Well, also, when it comes to NVIDIA, what Mandeep said is they have something that there's not enough of, and people are desperate to get a handle on that. And at some point, once that starts to become a little bit more normal, then where does the stock go?
I love that it's no longer the S&P 493. It's now the S&P 499. Is that what we're doing now?
100%. Wonderful
okay,
one.
That's what we're doing now. Let's check out the S&P 500. Equity futures negative here by 1/3%. Yields in the bond market down about a single basis point, 426.16. The euro totally unchanged, 108.07. Coming up shortly, Binky Chadha at Deutsche Bank weighing in on earnings season. Mizuho's Vijay Rakesh on why he thinks NVIDIA will remain an AI leader, and Stephanie Roth of Wolfe Research looking ahead to Fed minutes a little bit later on this hour. We begin with our top story. Stocks inching lower ahead of NVIDIA earnings due out after the close. Binky Chadha at Deutsche Bank weighing in on earnings season saying this: earnings growth this quarter is in our reading mixed. Despite the Q4 weakness, forward estimates for Q1 have held up very well so far and point to a return to growth. Binky, I'm pleased to say, joins us now. Binky, what for the catch up? We'll leave the stuff in a commercial break. Don't worry about that. Let's talk about the S&P 499. Do you see it quite the same way? This whole stock market is now just down to one name.
It's a question of, time horizon. Clearly, there's certain themes playing out, and at this stage, yes. I mean, it makes kind of sense that we focus on basically, the most prominent member or contributor of that. But, what we're really looking for is for the rally to widen out as what I would call basically the cyclical overhang starts to lift. So if you think about the cyclical overhang, the macro consensus has basically argued for a recession for a year and a half. It's now lifting its forecasts gradually. But there's no forecast that still matches the average growth that we've had for the last year and a half. So I would argue that it's still got some ways to go. That macro consensus, a very, very negative, grim consensus has been around for a while. And I would argue at this point has been really a big cloud on corporate guidance. So companies, there's many companies that see an improvement in demand, but just don't want to step in front of, what's a train that's been going at full speed for a year and a half.
In your most recent report, you went through all of this guidance from companies, and ultimately your takeaway is that they are reluctant to offer any forecast whatsoever on the global economy, even though they see things improving.
Well, so you have to look at it from their perspective, right? I mean, there's a macro consensus with lots of PhDs. It's for a year and a half, and it's not just the consensus. I mean, it's been pretty close to unanimous, I would argue. So it's not easy to step in front. Now, things are changing. I mean, if you look at various measures of CEO confidence, the story has basically been for last year and a half, 2 years, that in our industry things are fine, but prospects for the economy are terrible, and that's now picking up. So I would argue if that confidence continues to improve, and it will take some time, then you're going to start to see even the guidance basically come in. I mean, this is more widely speaking. I mean, if you look at any soft indicator, look at the PMIs and look at GDP growth. I mean, you have the survey is being filled out by somebody, and the data is being collected by somebody, and the gap's been huge for a year and a half now.
Our hotel guy was talking about how kids are out. There's quite a bit of demand.
Is that what we're calling the Marriott CEO now?
Mike Schumacher labeled him our hotel guy. But there's this question, the Marriott CEO, talking about a lot of travel demand, particularly even in China, places coming back. Given all this optimism, you have a range of potential S&P forecasts. Are you starting to kick out the most higher end one? I know that's barely English, but the 5,500 kind of target?
So we've, I think it's sort of important to keep in mind that, the equity markets already rallied quite a lot. So I wouldn't say equities are hugely expensive or anything like that, but, there's little doubt that valuations are pretty full. And so, we remain constructive, but we think the upside really comes from earnings. And earnings, of course, depend on the macro forecast, which remains very, very fluid. The 5,100 target that we have, that we put out late last year, is predicated on a house economics view that included basically a mild U.S. recession. But we did lay out, sort of 3 scenarios that cover the range from a mild, slowdown and mild recession in the U.S. to sort of where the consensus was. Deutsche Bank was below consensus at the time. And then there's, of course, what I already mentioned, which is average growth that we've had for the last 6 quarters. I mean, that seems like a rather simple forecast to have, but and it's been more right than any of the other 2, I would say, so far. So if you have the kind of growth that we've had for the last year and a half, then instead of the $250 for S&P 500 EPS that we have in our base case, you're talking about closer to 270. I would say the macro consensus has now moved up and is probably more consistent with, sort of the middle of that range, maybe a little bit less, but I would argue it probably has room to get upgraded. And so the 250 is 5,100, the 270 is 5,500, and so we've clearly moved in that direction. Yeah.
There is a question of, after the bell today, anatomy of NVIDIA earnings watching, and how you sort of gauge just the momentum that gives, not just the tech sector, but everything else. How are you going to look at these earnings? Can you give us a sense of what you're looking for, and then how you shift accordingly?
Yeah, so, there's the fundamental aspect of what we will learn from the earnings. And then there is, of course, the fact that a lot is priced in. The market is very, very long there. And I would say for mega cap growth in tech as a whole, so some time ago, a few months ago, we moved to neutral. We like the fundamentals, but we think more than enough's priced in, and we're really looking for the rally to go elsewhere, and that's really about the cyclical overhang that we were speaking about.
Let's finish up by talking about the rest of the world and the overhang there. I get that the stock market is not the economy, and stock markets don't have to correlate with the GDP of the country that index is located in. But UK GDP is negative. German GDP is negative. Japanese GDP is negative. Talked about this for a while now. China's really struggling as well. What is there to like about the international backdrop, ex-US at the moment?
Yeah, let's take Europe as an example. So, growth's been bad. It's been a year and a half. And the point that I would make is equities tend to bottom basically, about halfway through a slowdown. So you've got to think about it from a risk-reward point of view. If, the data is already bad and the PMIs are at 40, is the risk that we move up from here or we continue to go down? I would say the slowdown's well in the price and the market's starting to look forward. So if U.S. growth, global growth is better, then you want to own the cyclical parts and the parts that rely on the U.S.
If I was at home right now, I'd be nervous about the international story pricing in the recovery because I'd be wondering whether it ever bottomed. The DAX was up 20% last year. When did it start to price in the recovery before the economy even bottomed? What happened there?
So the DAX gets a remarkable proportion of its earnings in the U.S. relative to Germany. So
interesting.
I would keep that in mind. So we are interconnected. Yes, I mean the German economy does matter for the DAX, but other things matter too. So. You look at Japan. Basically, it's probably one of the markets that is most cyclically sensitive. But I would argue, put a cautionary tone basically on Japan because
on equities or the economy?
On equities because Japan, like most of the major regional equity markets, gets a very large share of earnings from the rest of the world. It's multinational corporates that are leveraged basically to global growth, and dollar yen matters a lot for Japanese earnings in yen. And so, at 150, where's the risk reward? I think it's very, very clear. And so I would be neutral to underweight Japan.
Interesting. Binky, thanks for that final point. Bigger chatter there of Deutsche Bank with the Nikkei last year up 28%. US stocks weren't the only game in town. It was a big game. Japanese equities were a big part of the story for some people too.
Japan saw real growth. It had been decades of repression, and all of a sudden there was a real optimism around the Japanese economy. Now there's a debate of whether it's all been priced in and whether there is going to be sort of this global hangover. But there still are a lot of people saying that is the new brightest shirt in the long term.
Yeah, maybe some asymmetric risk around this one at the bottom of the screen. Dollar yen at 150. Is downside risk much, much larger than maybe upside potential here on that currency pair?
It would be interesting to know how many people are going into the equities with a hedge on the currency, given the expectation of some sort of shift on the monetary policy side.
Dollar yen unchanged, 149.95, just about unchanged on the session. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Mining giant Rio Tinto is sliding in the London trade. The company reported profits that were down 12% last year on weaker commodity prices. A disappointing recovery in China has put pressure on demand for industrial metals. However, CEO Jakob Stahlholm told me earlier this morning that he's optimistic about the world's second largest economy.
There's a lot going on in infrastructure. There's a lot going on in a number of industrial sectors, not least the automotive with a near explosion in electrical vehicles. So net, the demand has actually grown last year. So we are facing a growing economy.
Despite Rio Tinto's results, the company is boosting its dividend to $2.58 per share from $2.25. The Biden administration is wiping out another $1.2 billion in student loans. About 150,000 borrowers are expected to benefit from today's announcement. The move helps those enrolled in the government's SAVE plan and wipes out debt for those who borrowed less than $12,000 and have been paying for at least 10 years. This pushes the total amount of student loan relief under President Biden to nearly $138 billion over 3.9 million borrowers. Amazon founder Jeff Bezos is selling more of his stake in the company. The billionaire unloaded another 14 million shares worth about $2.5 billion. That brings the total cash out to $8.5 billion. Bezos announced his plan to sell up to 50 million shares of Amazon earlier this month. He finished the transaction in just 9 trading days. That's your Bloomberg Brief. John.
Not bad work if you can get it. Danny, thank you. Up next on this program, the biggest earnings report of the quarter.
Artificial intelligence or the automation, the production at scale of intelligence matters to every single country and matters to every single industry.
The latest on NVIDIA up next. Live from New York City, 1 hour and about 15 minutes away from the opening bell. Slight weakness over the last couple of days, bit of weakness this morning as well, pulling back by 0.25% on the S&P. We're down a basis point on a 10-year, 425.96. Later on this afternoon, Fed minutes, and then this evening we'll be talking about this one thing under surveillance this morning, the biggest earnings report of the quarter.
Every single country will become a computer industry, and every industry will become a technology industry. And so artificial intelligence, or the automation, the production at scale of intelligence matters to every single country and matters to every single industry. Computer technology is going to impact literally every single industry in every single country. And so the markets are going to be quite large and global.
Here's the latest today. NVIDIA results due after the close. Investors waiting to see if the company's 40% year-to-date gains are justified. Vijay Rakesh of Mizuho saying this: we continue to see NVIDIA as the best AI and machine learning play, pushing the tip of the spear in AI training performance. NVIDIA currently dominates the AI server market, and we expect it to maintain its significant market share. Mizuho Securities, semiconductors and auto tech senior analyst Vijay Rakesh joins us right now. Vijay, wonderful to catch up with you, sir, particularly on a big day for this company. Vijay, bear with me. I'm going to go with that quote from Margin Call, which is speak as you might to a golden retriever. So do that if you can. This seems to be a stock that everyone talks about and a company that very few really understands. We talk a lot about this so-called H100. Can you tell us what it is and how big the moat is currently around this company?
Yeah, thanks for having me on, John. I think if you look at the H100, it's basically a GPU accelerated training chip that's used in data center or servers. But basically, that accelerates the whole training process. Is able to take data out of very large data sets and try to glean information and use that for prediction, etc. So it's basically a mega GPU that NVIDIA has. And they have the next version of the H100 coming out this year, which is called the B100. But that's really what is driving the tip of the spear in AI training globally. So they'll dominate that market as you look out.
And the demand for it has been absolutely phenomenal. Vijay, at the start of last year, we were talking about AI as a story for the future. And I think with this particular company, it became real. Every single earnings report, it was beat and raised, and beat by double digits. Vijay, going into this report, we've been trying to figure out what is a real beat today for this company, given how much this stock has run up over the last 12 months.
Yeah, I think if we look at the guide for April quarter, which is where all the investors will be focusing on, I think we are looking for about $22 billion on the top line, with about $20 billion of that from data center. But expectations are probably running much, much harder. I think it's probably in the $25 billion range, 23 to $25 billion. So that's what where expectations are. The one thing I would say is the AI continues to grow very well. Even for 2024, AI is growing almost 90 to 100% in revenues for NVIDIA. That's about almost 80 billion plus in revenues from just data center. That's about 1.5 times what Intel's revenues are today. So very big market for NVIDIA. So
Vijay, I'm going to bring it even lower. A GPU is a graphics processing unit. I'm looking through and trying to understand how these things are made, where you can have really rapid mathematical calculations at high speeds. Where is the barrier to entry? How high is it for other companies to come in and come up with mega GPUs that NVIDIA is churning out?
Yeah, it's very high because what you're seeing, there are two parts to it. It's not just the hardware, it's the software part as well. And what NVIDIA has done very well is build a very broad training container called CUDA, which can basically port data onto it, use data from anywhere, from AWS to Google Cloud to any of the big mega Facebook Cloud, etc., and use that data to train it. And they have multiple training models. They have a big supply chain, a lot of experience in doing it, and they're able to optimize and train it a whole lot faster. So that plus the hardware, as you mentioned, the H100, B100 that's coming up, drive what's really the whole platform training and AI on it. So for anybody coming in, yeah, the hardware part might be you can do it slightly better. You might try to gain a little, share there, but really where the rubber meets the road is you don't have that software training side of it. You don't have the breadth. You don't have that experience. You don't have the presence in multiple markets that NVIDIA has. So they really have been early to that game, have been dominating the market. And if you look at calendar 24, AI, we've been talking, it feels like for ages now. NVIDIA will do probably 80 billion plus, or close to 90 billion, let's say, this year in calendar 24, versus if you look at, the peers, somewhere in the 4 billion or under. So they are ahead by 10x, 20x versus the peers. So
we've been talking also about margins and how they're able to charge pretty high prices to cloud providers because there's no other game in town. What about the materials? How do they sort of source some of the things, especially at a time when we talk about electric vehicles and the lithium coming from China? Is there a similar type of supply chain that's underpinning NVIDIA?
Yeah, the manufacturing part is obviously through Foundry, which is in Taiwan, which is TSMC, which is the largest foundry in the world. But where they have a little bit of a bottleneck, and that's getting resolved as well, is with CoWoS. CoWoS is the type of packaging that is done with GPU on the substrate, on the wafer. And so that has been a little bit of a constraint, but that capacity is getting resolved as TSM adds almost 100% plus capacity there. And you are seeing new entrants, Amkor, ASC, potentially even Intel getting into the CoWoS side. You'll probably hear from Intel this morning on their IFS Foundry roadmap. But all those are trying to resolve that CoWoS bottleneck there and improve that supply to the customers, to the hyperscale OEMs.
The H20 chip is their most powerful chip that they can sell to China. What makes it different than their most powerful chip that they're able to sell to anyone else?
I think the H20 obviously is a little bit more, I think the training performance is a little bit more constrained than their leading edge because of all the restrictions that have been put in place. So it's kind of, geared more to the China market, but it's definitely not at the same training performance level compared to the H100 or the B100s coming up, right? So it's basically tuned and constrained for specifically the China market. So.
Vijay, forgive me, we'd like to talk about Tesla as well. It's a company that falls under your coverage. We'll be talking about this a little bit later this hour. Ford had to slash the price of its electric Mustang in the last 24 hours. What's your read on what's happening here? Is this a problem for Ford, for GM, and not a problem for Tesla, or a problem for everyone?
I think it's a little bit of a problem for everyone. And we had a big note on this early in the year, early January, when we did an outlook on the EV space. What's really happening is, obviously, a lot of the low-hanging fruit has been taken by Tesla. I think they've done a very good job of carpet bombing the automotive space, taking that EV market share. So now to get to the next level of penetration in EVs, you need to drop pricing. And I think as you look at Tesla, they are doing it. They have a new Model 2 coming out where they can start penetrating the market even more. Let's say if that's a $25,000 ASP model on the Model 2. But for somebody like Ford, GM, etc., the problem is they have to go through that full optimization. It's a catch-22. It's like a chicken or egg. You either scale up, get the volumes and drive the platform costs lower, or start from a lower price, which either way, you're in a bad spot, you're in a bad starting spot there. And so that's the challenge for Ford and GM, is that they have to compete with Tesla, which is a pretty massive manufacturing ramp, huge production scale, much better operating and leverage metrics than Ford or GM, which have much smaller scale and just starting off. But I think GM, as we have noted before, is doing a pretty good job building out their whole battery platform, building out the Ultium platform, and trying to get that cost down. But it's definitely a challenge.
Tesla is just a different beast at the moment. Vijay, wonderful to hear from you, buddy. Always is. Vijay Rakesh there at Mizuho on NVIDIA and Tesla. NVIDIA price target for Vijay, by the way, $825, up from $625 recently. So quite an upgrade from him. Tesla, we'll talk about it with David Welch a little bit later. The others are struggling here. Ford and GM, struggling on strategy and on execution.
Well, and cutting prices, and Tesla's done that too. How far are they going to have to go, even without necessarily having some of the Chinese auto manufacturers selling in the U.S.? Open question.
David Welch later this hour. Coming up next on this programme, Stephanie Roth of Wolf Research looking ahead to Fed minutes. They are coming a little bit later on this afternoon. Just hardly anyone's talking about it. From New York City, this is Bloomberg. Stocks down over the last couple of days. This morning we look like this, and good morning to you. On the S&P 500, negative by 1/3%, down 0.6 on the Nasdaq. This from Andrew Hollenhorst over at Citi. He's calling it carefully crafted minutes. FOMC minutes out today at 2 p.m, agreed upon after the release of stronger jobs. And inflation data should reinforce Fed officials' public calls for rate cuts to be pursued carefully without urgency. More informative will be tomorrow's packed day at Fed Speak, which is, Lisa, what you've basically said. Bauman, Harker, Cook, Kashkari and Waller all on the calendar.
That was very well done. I'd like to hear that again.
List gets longer.
Yeah, but this is basically what are they going to say? And ultimately, they have nothing to lose to keep the status quo, because the status quo seems to be kind of moving in their direction.
Let's turn to the bond market. Yields lower by 2 basis points. The 2-year just short of 460, 459 on a 10-year, basically unchanged at about 427. In foreign exchange, the euro shaping up as follows. Unchanged through much of this morning. 108.04. That currency pair is negative by 0.04%. Under surveillance this morning, the so-called most important stock on earth reporting after the bell, Nvidia. The chip maker facing sky-high earnings expectations. Investors will decide whether the company's earnings and forecasts justify a gain of 40% year to date and a market cap to rival Amazon. The company at the centre of the AI frenzy, adding almost $500 billion in market value since January. It's not bad, is it? It's not bad.
It's 2.5 Disneys.
It's basically 2.5 Disneys, yeah.
That's basically what we're talking about.
Isn't that what Meta did in a single day?
It did it in a single day.
The market cap of Walt Disney. Which speaks to how insignificant all these other stories are for the S&P 500.
Which is the reason why people don't even care if it broadens out. And the fact that it hasn't been, people are saying doesn't matter. This is the most important stock on earth, and it's going to really determine the direction of everything else. That said, does it really, or is this basically a harbinger of strength that comes on the heels of this as companies adapt to similar types of technology?
I do think beats are built differently at Nvidia, which is maybe why we've pulled back over the last 3 days or so. Day 4, by the way, we're down now, Lisa, by almost 2%.
Basically just cashing in before you sort of get the release and figure out what's going to happen.
How many double-digit beats can you get? You know,
although
can we get more?
This concept, the conversation we just had with VJ, I thought was fascinating, actually, because if you think about it, if it's a high barrier to entry and every single cloud computing company needs this in order to be on the current cutting edge, people can't get enough. You kind of have to think that's the reason why people are so enthusiastic.
Which is why it was the number one performing stock last year on the S&P, and so far this year, the number one performing stock on the S&P 500 or the S&P 1 versus the S&P 499.
It's true.
I know. Nikki Haley isn't backing down. Here's the latest on that. The second-place GOP candidate, second place out of 2, vowing to stay in the presidential race regardless of the outcome of Saturday's South Carolina primary, and saying she won't buckle to pressure from frontrunner Donald Trump.
I refuse to quit. South Carolina will vote on Saturday, but on Sunday, I'll still be running for president. I'm not going anywhere.
I'm not going anywhere. Haley's struggling to get a boost from voters in her home state. Trump's leading by more than 25 percentage points. AMH, if this wasn't Donald Trump, if this was any other race, and we had a candidate 30 points behind who'd been absolutely dominated in the way she has been in the primaries so far, would we even be talking about it?
No, she'd probably be dropping out also and cozying up to try to get the VP spot. But we're dealing with a candidate who's dealing with more than 90 indictments. There's potentially is going to be convicted before the November election. You know, it depends on the timeline. So it feels like, and she would never say this, you know, when she got up yesterday, everyone thought she was going to say, I'm losing the campaign, given the polls. She's sticking around. And this morning, Suffolk University USA Today, 2-1, 63-35. And she says she's going to continue.
So you said it, she won't say it, but ultimately, what is the strategy? What is people saying about this? Is the strategy now just be the last person standing and see if he's forced to drop out of the race?
An alternative if it cannot be him.
OK, Bramo?
I just think people are holding their breath, hoping that this isn't the reality, that we're doing a reappeat of 2020, and it is.
It is. Without a doubt.
Point blank.
It is, which is why I think they still entertain this story so much. I've got no idea what's going to happen. Things can change. Big things can happen. But ultimately, this is it. And the reason people keep entertaining someone who's 30 points behind in the race when in any other race they wouldn't is exactly what you described. The dissatisfaction for a large amount of this population away from the Trump base who just simply don't want it to be these two individuals facing off again.
We talk to executives every day, and analysts and economists, and they want to talk about policy. They want to understand what's actually going to drive better economic conditions and a better quality of life. That conversation is nowhere in Washington, D.C. It's a lot of messaging and a lot of spin, but it's not a lot of trying to really get to the bottom of it. And I think a lot of people are frustrated.
What bugs you more, politics or monetary policy?
Oh, definitely politics. Monetary policy is really fun.
Let's get to monetary policy. Fun minutes from the Fed's January meeting due out at 2 p.m. this afternoon. Investors looking for insight into the committee's confidence in disinflation before they cut rates. Bloomberg Economics expecting the minutes to suggest officials are ready to discount recent hot inflation prints. We'll get more insight into the central bank's path forward when we get a slew of Fed speak tomorrow. Mike McKee's down in Washington, D.C. with a preview for you. Mike McKee, what are you looking for later this afternoon?
Well, I have to tell you, John, we are really honored here on the Bloomberg Fed team to be the opening act for NVIDIA this afternoon. It may last about 2 hours between us and their release, and that may be enough time for people to react to what we're going to get, which may not be all that much. We are expecting the Fed to sort of lay out the conditions under which they might cut rates. But remember, this was 3 weeks ago, so they'll be talking about in the minutes pushing back against markets that have already repriced for when the Fed might move. They'll also be restating probably their view, 3 cuts, and they'll give us an economic outlook, what they saw at the time. This was January 31st. And of course, at that time, we didn't have the higher CPI. We didn't have the stronger labor market news. So if we get something out of it, it might be some idea of conditions under which they might cut. But since that meeting, we've moved on quite a bit, both in the economic assessment and in what people have been telling us.
Mike, Andrew Hoddenhorst, the city, called it carefully crafted minutes. How carefully crafted, edited will these be, given what's happened in between this meeting and this release?
Well, that's a good question. I don't know as they have to edit it a whole lot because market perceptions have already changed. If you were trying to push back on something, then you might try to push the minutes one way or another to give market participants an idea of what you want them to do. But in this case, the markets have already done what the Fed was wanting them to do, what Jay Powell was talking about at the news conference. So I'm not sure they have to carefully edit these as much as they might in other circumstances.
Mike McKee, thank you. Looking forward to the preview, the appetizer before the big one a little bit later on this evening. Mike McKee down in Washington, D.C. The brilliant Stephanie Roth of Wolf Research with us around the table now for more. Stephanie, good morning to you.
Good morning.
You've been dead on the economy. You said the risk here was upside risk, the potential this economy continues to do OK. How does that shape your Fed call now?
Yeah, I mean, we've been consistently calling for the Fed to be cutting in June. Our base case is that remains. We think that a lot of the inflation data that we saw recently was largely seasonal, and that will reverse in the next couple of months, which will then put the Fed on path to be able to cut in June. Of course, the risks are that it has to be a little bit later, and then you run into election timing, so it gets a little bit complicated. But we very much think that the picture will look different by June.
When you say seasonal, what does that actually mean in practice? What happened?
So I would call it like this January effect. And we were looking for that ahead of the print, and it was even more severe than we were expecting. So what tends to happen is in the month of January, you tend to have annual price increases that go into effect. And what happened, we believe, in this past month is we were just catching up to a strong year of inflation, so that price increases were more significant than the seasonals were prepared to adjust. And that's what we think is the main driver behind the strong PPI, strong CPI, and we should get a reversal in the next month. Then you had OER, which is a whole different kind of conversation.
Though the fact that some of these companies were able to increase prices as much as they did does raise some alarms. And I do have to say, Torsten Slok put out a really good graph today talking about how the share of private consumption spent on services is still 2 percentage points below where it was pre-pandemic. In other words, there still is ammunition to be poured into this consumer economy. How do you sort of factor that in when you start expecting that disinflation to take hold in a more significant way?
We're probably just settling at a new trend. The consumer's now likely to just spend in line with their income growth, which is now running at a more normal type of pace. So we're probably not going to get quite back to that pre-pandemic trend level, and we'll just settle off at a new trend, which would then be able to sort of stabilize the inflation outlook.
So you think that people have found discipline?
Well,
moving on. I do wonder, though, what you make of the idea of credit card spending and the credit card outstanding and the delinquencies, which doesn't exactly scream of incredible discipline.
Yeah, and it doesn't. In the fourth quarter of last year, we saw credit card spending pick up notably. Our base case is that will slow down a little bit in the first quarter just because we spent so much in the fourth quarter. People are probably just a little bit tired of all that spending. But outside of that, we don't have this excess savings anymore. That's largely spent through, except for the top income earners, and they're probably not going to spend it. So now it's probably more about nominal income growth, because credit card rates are so high. Yeah, buy now, pay later, that's something that does concern me a little bit. But generally speaking, the consumer's probably just going to spend in real terms close to 2%.
Out of interest, why does that concern you, the buy now, pay later?
Because there's just not that much rigor in terms of the process, in terms of looking for whether these people are really able to borrow. It's a lot less stringent of a policy. Right now, it's not that large, but it's possible as this grows, it could become a source of some negative credit.
I know this is not your base case. Can you just do some scenario analysis with us? If the dual mandate of the Federal Reserve went into conflict, if unemployment started to pick up but inflation was still sticky, what guides you and gives you an idea as to what the Federal Reserve would prioritise at that point, if that was to happen later this year?
My base case is they'll prioritize the unemployment side. If you get to the unemployment rate rising well above 4%, if we're moving steadily towards 4, just above 4, I don't think they'll react. But if we're moving well above 4%, they're going to be looking ahead to what's going to happen to inflation in the future after that, and very much so. It's a lagging indicator. The expectation to be rising unemployment is going to slow down inflation in the future.
You talk about employment, and people say that really holds the key to consumer strength and the economy and just how long this can continue. How much is the hot labor market reports a function of people getting multiple jobs?
Yeah, there's definitely an element of that. And that's one reason why you're seeing significant strength in the establishment payrolls report as opposed to the household survey. I think that's kind of one factor that's explaining some of that. But I also think some of that was seasonal. So going back to all of these seasonal problems that happen in the months of January, we tend to get seasonal strength in that particular month because we tend to lose less jobs than the seasonals are looking for, and that boosts the print. So let's look to the February print and see how much of that was actually sustained.
How much are you going to hinge your call going out the rest of the year based on NVIDIA earnings?
Not much, but what I would say is that what we're seeing is a legitimate investment in the tech space, and this is going to be important for productivity looking forward. Not necessarily today, but in the next couple of years, this could be really important for the U.S. economy, which is going to put downward pressure on inflation if productivity really picks up.
That was the smart answer that Lisa wasn't looking for. Stephanie, thank you. It's good to see you. Appreciate it. Stephanie Roth there of Wolf Research on the Federal Reserve and on NVIDIA as well. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. plans to unveil sanctions against Russia on Friday following the death of opposition leader Alexei Navalny. The president blames Putin for the death of Navalny, who had been imprisoned in the Arctic. The White House says the sanctions include a substantial package of financial penalties targeting Russia's defense and revenue sources. Goldman Sachs says hedge funds paired exposure to Mag 7 stocks in the fourth quarter. The firm looked at more than 700 funds with $2.6 trillion worth of equity positions. The only Mag 7 stock that saw an increase was Amazon. A tie-up between two supermarket giants could be in trouble. Sources tell Bloomberg that the FTC and a group of states will sue to block the combination of Kroger and Albertson. The suit is expected before Feb 28th. That's when an agreement not to close the deal expires between the FTC and the companies. Both Kroger and Albertson are prepping to meet with FTC Chair Lina Khan to persuade the agency not to sue. And that's your Bloomberg Brief. John.
Danny, thank you. AMH, we asked this question earlier on in the show this morning. What kind of deal will they like down in Washington?
Well, you look at Kroger and they're saying, how do you expect us to keep up with Walmart, with Amazon? We need to get a little bit bigger. And they say that this is going to help boost wages, while the FTC and people like Senator Elizabeth Warren say it's actually going to hurt workers, it's going to be bad for unions. But if you look at why can't Kroger and Albertson get through? How the heck is Capital One and Discover going to have a chance?
Exactly. That's such a good point. I also want to know, for Senator Warren specifically, what company would she like to get with another company? Is there any kind of consolidation that she would approve?
Maybe a deli on one side of the street and a deli on the other side of the street.
Even that would be problematic.
But that could be problematic because then they could jack up the prices of coffee.
It's so predictable down in Washington sometimes. We were all waiting for that tweet yesterday, weren't we? It actually came later than I thought.
You thought it would be earlier today?
The one I wasn't expecting was Kroger, and then we had our reporting that the FTC is going to move on it.
It's true. It's the year of the regulator down in Washington, apparently. Up next on this programme, EV demand in focus.
We are developing a low-cost EV platform so that we can be a big part of this S-curve when it comes time. And that is, I think, coming in a couple years from now.
That's next on the programme, live from New York. This is Bloomberg. Big afternoon just around the corner, not the Fed minutes. Nvidia earnings after the close. Looking out for that. Equities right now pulling back just a little bit. We're down a third of 1% on the S&P 500. 2-day losing streak could become 3. 3-day losing streak for Nvidia down again this morning. We'll see how that shapes up a little bit later this afternoon. Yields are lower by a basis point or two. We're down almost 2 basis points to 425.96, and the euro is doing absolutely nothing through much of today. Under surveillance this morning, EV demand in focus.
We are developing a low-cost EV platform so that we can be a big part of this S-curve when it comes time. And that is, I think, coming in a couple years from now. And I think it's going to be a big inflection point for the industry when more affordable EVs come online.
Here's the latest right now. Ford slashing prices for its electric Mustang after sales tumbled 51% in January when tax incentives were removed. The legacy automaker dialing back expansion plans as overall EV sales fell 11% at the start of the year. This ahead of Rivian and Lucid earnings coming after the close, both startups having to contend with the broader slowdown in EV demand. Bloomberg's David Welch joins us for more. David, wonderful to catch up. You're in the heart of this. Can you just tell us what is the big struggle? Is it infrastructure? Is it range anxiety? Is it price, the lack of tax incentives? David, what is it?
It's all of the above. Price matters. You know, there's one EV on the market that sells for under $40,000. It's the Nissan Leaf. It's a compact. Americans don't like compacts. It gets about 200 miles of range. Everything else is pretty pricey, and the early adopters and luxury buyers, they've sort of gotten full up on their EVs. At this point, they're not buying, that many new ones. They've already got one in their garage. And we're trying to reach the mass market here, which is very difficult because the vehicles are expensive, because the charging infrastructure is not there. And, people are pretty happy with their gasoline-powered vehicles. So you got to give them a reason to trade up, and we're just not seeing it yet. And that puts a lot of these companies, particularly Lucid and Rivian, in a tough spot when they're trying to grow volume. The forecast this year for Rivian is 66,000 vehicles, which is decent growth from the 50,000 they sold last year in percentage terms. But 66,000 vehicles is still tiny numbers in terms of getting scale in a march toward profitability and cash flow positivity.
So some manufacturers, David, as you know, leaning towards hybrids. As you also know, General Motors has been reluctant to do that. They think that EVs are going to ultimately take off and they'll be the right place at the right time. You got a sense that maybe that's changed over the last month or so over at General Motors, David. And I think the question we were asking at the time is how easy is it to make that shift on the production line and develop hybrid vehicles to really get to where this market is currently, not where it will be in several years' time?
They have the hardware. They've sold plug-in hybrids in China. They still have the technology, but you still have to go in, re-engineer the vehicles, get the assembly lines to do it. It's not a snap, and that's why you notice GM hasn't said they're going to do this in 9 months or get it done this year. It's more of a probably 2025, 2026 sort of thing. And it won't be in up and down their lineup the way it is with Toyota. I think you'll probably see General Motors do it in the very high volume segment. Maybe they're the Chevy Equinox, which is a small crossover. Maybe they're large pickup trucks, and then maybe a kind of a big family hauler SUV like a Chevrolet Traverse. They'll do it in 3 key areas where they do a lot of sales volume to give customers that option. But it does hurt profitability because plug-in hybrids are expensive to make. You're talking about having an electric system on board, and then you're still having a gasoline engine, exhaust system, and all that sort of thing. So it really does. They are very expensive vehicles to build, and that's why a lot of companies have shied away from doing them, hoping they could go straight into the EV transition, but consumers just aren't coming along.
David, is the Inflation Reduction Act and this administration's policies helping or hurting U.S. auto manufacturers in the electric vehicle transition?
Well, it isn't helping yet because this stuff has just started. The consumer credits are just getting underway. And then there's a lot of money that goes straight to the automakers, but they have to build and sell the vehicles. And so you have 2 problems here. One is the sales have slowed down. And the other one is the companies have had a tough time building them and getting them out the door at prices and with the kind of variety that consumers want. So you're not going to get this incentive money from the IRA until everything starts going. So it's a bit of a chicken and egg issue right now. There's also the other challenge the car companies have, which is meeting all of the requirements and getting all of the minerals that go into the batteries and all of the parts from either friendly trade partners to the U.S. or domestic production so that they can qualify for the full $7,500. And that's why you've seen some of these vehicles lose the credits, and then they lose sales because that $7,500 makes a big difference for buyers.
Well, if they started to loosen some of those rules, would it improve the market and help this EV glut?
It probably would, but it was such a big fight to get all of these different incentives approved. And there was very much a desire by Senator Manchin and a lot of Republicans to make sure that these incentives didn't just help China continue to grow its EV supply chain. And I just don't see the flexibility coming in because it was such a battle to get this approved in the first place.
David, can we ask you, is this uniquely an American problem, a US market problem for these manufacturers? Do you see the same thing in Europe, in China, with the adoption rates?
Look, China and European buyers are both, they're buying a lot more EVs. Now, the governments there have a lot more restrictions on where you can buy internal combustion vehicles. The incentives are higher. They've really pushed this a lot harder than the U.S. government has. But, you know, America's a different market, too. You don't have, people who are just living in urban areas where they have access to charging and driving short routes. It's a big country, and people need hundreds of miles worth of charging, or at least they think they do, in order to use an EV in their everyday lives. So there's a lot of pushback based on that. And, Americans are kind of happy with the vehicles they're driving right now. And until we can solve some of these problems, some of these pain points, I think it's going to be a struggle to get the aggressive sales growth that we saw over the past few years.
It's true, you've said it, the demand for the traditional vehicles is still pretty rock solid, sky high in some places. Can we just finish on this, David, what you would be looking for as a next step from some of these manufacturers? We've seen the price adjustments for certain vehicles. We've talked about GM, I would say flirting with the potential, the possibility of leading towards hybrids. What's the next step for you? What are you focused on?
Look, I'm watching to see who's going to be adding more plug-in hybrids and hybrids, because that'll give us a clue as to what they think this transition is going to be like. And the other part of this is the only way you really juice EV demand again is fundamentally changing the vehicles available in the market. So we'll see General Motors and others coming out with usable, lower-priced EVs. We'll have a Chevy Equinox selling for $35,000 later this year, and that's sort of GM's family car on the gasoline side of their portfolio. To me, that's a big test, whether or not the mass market, your consumer who has one vehicle, not three in their garage, is ready to go electric. It's a $35,000 vehicle, goes more than 300 miles. If it's going to hit, that's the kind of vehicle people are going to want. So we'll see that. Maybe Ford will come out with a lower-priced EV in the next couple of years. Tesla has talked about it, but we need to see vehicles in the $30,000 range, and we need to see consumers buy them, and we'll see if they really want them once they do hit the market.
Yeah, that last point is kind of the important point. David, it's good to hear from you. As always, David Welch there of Bloomberg out of Detroit on the latest difficulties that they're having. Big day ahead. Federal Reserve minutes a little bit later on this afternoon. Massive earnings report as well. Final thoughts, Bramo. What are you looking for?
I'm excited that NVIDIA is the main topic. I think it's actually really great because it's the transition. It's this question of hype versus reality. It's sort of the reality on the ground for a company that has dominated so much of the narrative for the past 18 months. To me, that's more interesting right now than Fed policy.
Well, I'm going to take the other end of the fact that I was reading for the Center for Strategic and International Studies report last night. Mag 7 companies, Apple, Amazon, NVIDIA, 90% of what they need to get done in terms of processing, manufacturing, done in Taiwan. No one talks about this geopolitical risk that's a major cloud over what is lifting our entire stock market.
It takes me to my final thought. China, China, China. I know we've joked about it. It's amazing to see this country struggle to really put a floor under its equity market. I think the fact that they are potentially coming out, according to our reporting, and basically banning large institutions, major institutions from net selling at the start of the session and the end of the session speaks to how nervous they are about the fundamentals on the ground.
Although we heard from Tony Capuano about the incredible demand to travel, the conflicting signals, that's why it's so strange to me. How do you get a real read on something that is fuzzier and fuzzier?
Follow the policy would be my advice on that one.
Wise.
Coming up tomorrow, Dan Ives of Wedbush on NVIDIA, Kathy Jones of Charles Schwab on the Fed, and Moderna CEO Stefan Bancel and Porter Valet Executive Director Gene Soroka. All of that and a whole lot more. Live from New York City, happy NVIDIA Day.